guys, how are you all? My name is Afreen Azmat and I welcome you all in today's session. So, this session is indeed very important for all of you guys. Why? Because in this session of PPP, I'm going to cover all modules, module A, B, C, D in this complete one video. So, you will not only get the conceptual clarity, but a lot of questions also to practice yourself. This video is very important for all you bankers, for your preparation and for your clearing clearing your examination. Thank you so much, everyone. Just watch this video and enjoy. Thank you. I am your PPB and IEIFS educator for this, right? So first of all, let's start with the very first unit, that is banker customer relationship. This is PPB Module A Unit 1. Okay, so let's start. First of all, I am not covering the complete unit. This is only the important portion for you all. Okay, so first of all, the banker customer relationship is a debtor and creditor relationship. So there is a very common thing that you all know, that bank act as a creditor and the customer is acting as a debtor. But always remember, the vice versa is also true. Acha, who is debtor and who is creditor? Creditor is the one who is giving you the money, right? And debtor is the one on whom the money is actually due, who is responsible for paying back the money. Okay, so when customer is depositing money to the bank, when a customer is depositing money to the bank. Now, in this condition, always remember, a customer is depositing money to the bank. The money is owned by the customer here, and bank is responsible for returning that money whenever the customer demands, right? So, in this case, bank become debtor and customer become the creditor when a customer is depositing the money, right? But if we talk about the loan cases, when the bank is giving you the loan can be of any type. It can be the house loan, it can be the gold loan, it can be anything. So when the bank is giving you the loan, okay, so the bank is giving you the loan in this case because the money is with the bank, the owner is the bank. So bank is the debtor. Okay, bank is the creditor and customer becomes the debtor. So these are the two things which you have to remember. First thing is, when you money is due on the bank, it is the case when the customer is depositing money to the bank, right? In this case, customer becomes creditor, bank becomes debtor. Now, the second case, when you receive loans from the bank, now the loan is given by the bank to you, and that's why bank become the creditor and you become debtor, right? Okay, next thing is bank acting as a trustee. Now, when customer is giving certain valuable items to bank for the safe custody of that thing, right? The customer is depositing certain official documents, property papers to the bank for the safe custody of that papers, for the safety of that official document. In this case, the customer is trust bank with the important documents, and that's why in this case the customer become the trustee. And sorry, the customer is trusting on the bank, so the bank becomes the trustee, right? And in this case, always remember, bank become trustee as well as bank becomes the bailee also. Okay, so bailer bailee concept, always remember, the bailer in bailer bailee concept, customer is the bailer and bank is the bailee, and vice versa is not true, right? So here in debtor and creditor, vice versa is true. But in bailer bailee concept, vice versa is not true. Always the customer is the bailer and bank is the bailee. In which condition? The same condition in which the bank is acting as a trustee. When the customer is depositing certain valuable documents, securities, shares to the bank for the safe custody of these things. Now, in this case, the bank, besides acting as a trustee, bank act as a bailee also. and the bailee is responsible for the safety of that goods, right? And who is giving? The customer is giving. So the customer is the bailer and the bank is the bailee, right? Now in this case, always remember vice versa is not true, and do not get confused. The one who is receiving is the bailee, and the one who is giving is the bailer, right? Okay, next, the agent principal relationship. Now, if we are talking about the agent principal relationship, so agent and principal relationship, before the agent and principal relationship, let us discuss what is agent and what is principal. So, agent is the one person who is responsible for uh, acting on the behalf of the principal. So, agent is the one who is actually following all the footstep of the principal. Whatever the principal is saying, agent is following the direction of principal, and the principal is one person who is direct agent to do something, right? Now in this condition, see, first of all, if we talk about in this condition agent principal relationship, see, in agent principal relationship, bank is always acting on the behalf of its customer, right? Okay, so the customer is saying that, okay, the customer is instructing banks that please deposit this check, okay, or for example, please deposit this electricity bill, please pay the club fees, please pay the insurance premium, right? So the customer is instructing bank to do certain things, right? So the customer is principal, the one who is directing, and bank become agent here. Bank becomes what? Bank become agent here. Clear? So the customer is the principal and bank becomes the agent, right? Now, lesser lessee concept, if we talk about the lesser lessee concept. Now, who is lesser and who is lessee? Okay, so lesser and lessee concept arises in the locker rent case. Okay, when a customer is actually providing a locker space, when a customer is provided by a locker space from a bank, means a bank has some locker, okay, and bank give that locker space to the customer for the safety of their valuable items. Yes or no, right? So in this case, always remember this: when a bank is giving that locker space to the customer, and on the behalf of this locker, the customer is giving the lease rental to the bank, right? So bank is giving, so bank is a lessor here, and customer act as a lessee. In bailer bailee concept, always remember the customer is depositing certain valuable items with the bank for the safe custody, and because the customer is giving, the customer is the bailer and the bank is the bailee. Here the bank is giving that locker space to the customer for the safety of their valuable items, and that's why bank is acting as a lessor here and customer is acting as a lessee here. Clear? Done. So this is debtor in creditor. Always remember, debtor and creditor, vice versa is always true. Bank can act as a debtor as well as a creditor. Customer can act as a debtor as well as a creditor. Right? Bailer bailee concept, vice versa is not true. Bank is always the bailee and customer is always the bailer. Lesser lessee concept, customer is always the lessee and bank is the lessor. Agent principal, again vice versa is not true. Bank is acting as an agent who is working on the behalf of customer, means customer is the principal. Clear? Bank act as a trustee also, in which case when the customer is depositing certain valuable items to the bank for the safe custody. Clear? Everyone, yes or no? Right? Now let's discuss some practice question. First of all, the first question, you have to choose the correct statement here. Everyone, please answer this question. Very easy. You can all answer this question. First, bank is a bailee, customer is a bailer, bank is a bailer, customer is a bailee. You have to choose the correct statement here. Everyone, please answer this question. And just please, everyone, like and share the video to the maximum you can. Bank is a bailee and customer is a bailer. Bank is a bailer and customer is a bailee. You have to choose the correct statement here. Everyone, please answer this question. You have to choose the correct statement here. So I have always told you the vice versa is not true. So only one statement is correct here. And always remember the customer is the bailer and bank is the bailee. So only first statement is correct. Okay. Now in which condition? When a customer is depositing certain valuables with the bank for the safe custody, it can be some official papers, documents, shares in anything. Then in this case, the bank is a bailee and customer is a bailer. Right? Now, the last question is, when a bank lends money to the corporate person, bank lends money to the corporate person, the relationship is of borrower and lender, debtor, creditor, creditor, debtor, and customer and client. Very easy. Everyone, please answer this question. Very easy, you can all answer this question. When a bank lends money to a corporate person, the relationship between them is of, the relationship between them is of what? So the correct answer is bank is lending money. Bank is lending money. So bank is a debtor and customer is a creditor. Now in this case, bank is a creditor. So B is the correct answer. B is the correct answer here. Because bank is lending money, it is giving loans. So bank is a creditor and this is a debtor. Right? So B is the correct answer, creditor and debtor. Clear? AML KYC guidelines. So again, I am not going to complete this chapter because this chapter is a very lengthy topic. I am just going to discuss one and two important topic which is related to your examination. Okay. So everyone just kindly comment, is everything is working fine? Audio, video, everything is working good? Everything is working fine? Yes or no? Hi guys. Good morning. Okay. So we are going to start the AML KYC guidelines, right? So AML KYC guideline, first of all, the very important thing that is known as money laundering. What is money laundering? Money laundering is a process of cleaning the dirty money. Dirty money is what? Dirty money is when you are originating any money from any illegal source and infusing it into the financial system and creating a illusion that it has been generated from a legitimate source, then it is known as the money laundering. Okay, so money laundering is what? Money laundering is the process of laundering the dirty money. Okay, money laundering is what? When you have dirty cloth, you will put that dirty cloth in the washing machine to clean it, right? So the same process is here when the money is generated from illegal activity. Now this money need to be laundered, right? This money need to be cleaned, and that's why this money is introduced in the financial system in such a way that it has been originated from a legitimate source, then it is known as the money laundering. Now, if we talk about the money laundering, there is money laundering, there is a financial crimes, and there is terrorism financing. So these three are actually considered as triads. Triads means these three are very closely related with each other. The money laundering, the financial crimes, and the terrorist funding, right? So these three are very closely related with each other, right? Next, if we talk about the stages of money laundering. Now, what are stages of money laundering? So, just look at this picture. Okay, so there is a one person. First of all, he derived money from any of the criminal activities like drug trafficking or anything, right? Now, this money is now placed into the financial system. First, the very first step of money laundering process is the placement. Whenever the dirty money has been earned, now this dirty money is put
into bank accounts, right? So there are multiple bank accounts which has been opened and the money is put in the bank account. This putting money into the financial system, this infusing money into the financial system, it is called as the placement, right? Now, second is layering. Now you have moved this money. You have to move this money into multiple bank accounts, as well as each bank account is layered with some good financial transaction. Why? So as to hide the original source of this. So as to hide the original source of this. This is known as the layering, right? And there is a fourth stage or third stage which is known as integration. Integration, now all these monies are collected. All these money are collected and then this money is utilized for acquiring some assets. Now this money is utilized for acquiring some asset which is known as the integration, right? So these are the stages of money laundering. The very first stage is the placement. Okay, first the money is earned. Now this money is placed into the financial system as if it is generated from a legitimate source. This is known as the placement. Second step is layering. Now this actually moved to different accounts, okay, and layered it with the good transaction so as to hide the original source. And third is the integration. Now these money are integrated and then this money is what? This money is actually utilized to acquire some asset which is known as the integration. These are the step of the money laundering, right? Placement, integration, and layering. Next, money laundering offenses. Very important thing. So there are obviously different guidelines and frameworks that has been introduced to prevent this money laundering. And there is an organization which is known as Financial Action Task Force. Financial Action Task Force is responsible for formulating guidelines and framework for the anti-money laundering thing, right? Now, what happens if you are found guilty in money laundering case? So, first of all, according to the Prevention of Money Laundering Act, Section 45 describes this money laundering offense as cognizable and non-bailable offense. Cognizable means you are arrested without any warrant, and non-bailable means you will not get bail in this money laundering case. So, this is Section 45. Now, what is the punishment? So section 4 of this act defines the punishment of money laundering offense, and it is a rigorous punishment of not less than 3 years up to the maximum of 7 years. So this is not less than 3 years to the maximum of 7 years. And if it is related with any drug or psychotropic substance, then it is up to maximum of 10 years also. So this is the punishment depending upon the gravity of the task, or given gravity of the crime, the imprisonment is decided, and it range between 3 years to 7 years. Okay, Next is know your customer policy. See, KYC, know your customer policy. It is actually a process of identifying the customer. The process of identifying and verifying the customer and just checking it that the customer is claiming, whatever customer is claiming is correct or not correct. That is known as KYC. See, in early days when a new customer is coming to the bank does what? Either the bank just have the identification of that person from any existing customer, or there should be any employee who is identifying that customer. It was process, but it was process which was not applicable in the case of opening of a new branch, right? And that's why the bank comes up with the innovative thing that is known as Know Your Customer, KYC. KYC is the proper process of identification and verifying the customer's identity, right? So, for example, I'm going to a bank and I'm claiming that my name is Afreen Azmat. So, the bank need to check, okay, you are claiming that you are Afreen Azmat, whether you are Afreen Azmat or not. This process is known as Know Your Customer policy. Okay, so it is a mandatory process of identifying and verifying the client's identity while opening the account and periodically over time. In other words, MAC must ensure that the clients are genuinely who they claims to be. Right now, under this KYC, there is a very important thing that is known as a risk categorization. So, if there is any new customer coming, okay, in the bank, the customer is actually categorized into three risk. Okay, the customer is actually categorized into three categories. Okay, first is the medium risk customer, high risk customer, and low risk customer. For example, if you are any customer who are dealing more and more in cash, like jewelers, you are a high risk customer. If you are any person who are an employee, okay, normally you are receiving salary on every first and everything is cool and good, then you are a low risk customer. And risk categorization, the checking and review of this risk categorization is done or carried out on every 6 months, right? So this is known as the risk management. So this is some of the important topic for AML and KYC guideline. Let's practice some question. The very first question is, customers are typically categorized into how many risk categorization? Everyone, please answer this question. Customers are categorized into dash risk categories. I have told you. Please answer this question. So, customers are actually classified into three risk categories: high, medium, and low risk category, right? So three risk categories, customers are typically categorized into three risk categories, right? Next, see, which of the following describes the money laundering process? Which of the following describes the money laundering process? Placement, layering, and integration. Yes, all of the three. So all one, second, and third. Placement, placing into the financial system the dirty money and creating the illusion that it has been generated from a legitimate operational aspects of KYC. So we have the small idea, or we have revised what is KYC in the unit second, but this is actually a very detailed thing, that what is the operational or what are the operational aspects of KYC. So I'm going to tell you the most important things related to the chapter. Okay, so this is not the complete unit, it is only the most important thing related to the chapters, right? So let's start with very first, what is KYC? Let us discuss what is KYC first, to know your customer. And I know that you all know that KYC is the process of identifying and verifying the customers or the client identity. So if you are going to have any of the transaction, either financial or non-financial transaction with the bank, okay, and you are going to a bank, so the bank has this requirement that bank need to first of all identify the customer, and second, the verification of the identity of the customer. And in very simple term, the bank need to be ensured that whatever the customers is claiming or telling, it is correct or not correct. The process of this is known as KYC, means know your customer. Now, what are the important elements of know your customer? So the very first thing is the customer acceptance policy, then customer identification procedure, customer due diligence procedure, identification of the beneficial owner, enhanced due diligence requirement, simplified due diligence requirement, customer level KYC and monitoring, and periodic updation. So these are the operational aspects of KYC. So we are going to discuss one by one everything in detail. First of all, what is the customer acceptance policy? So customer acceptance policy says that the very basic and the very first step of the customer is the bank need to accept you as a customer. For example, I am going to a bank and I am telling the bank that my name is Afreen Azmat, I want to open an account. First of all, bank need to accept me as a customer. So there are certain guidelines, like if I am going to a bank and I'm saying that my name is no name, or I am in Benami. So bank reject me at once. Why? Because the customer is not accepted. So here always be true that a customer need to be accepted first by the bank. And what are the conditions for that? First of all, no account is opened in any anonymous or fictitious or Benami name. For example, I am saying that my name is Batman. So my account is not eligible. I'm not Batman. This is a fictitious name. Okay. My name is no name. So account cannot be opened for such customer. Okay. To verification or for verifying the identity, see, PAN is compulsory. So PAN account, permanent account number, it should be obtained. So you have to verify the digital signature of the customer also. And always remember, if you're taking the PAN card as a banker and you are saying that for example, you are saying that okay, I belong to a very low income category group, this shouldn't be the criteria of rejecting my account services, right? So you shouldn't be rejecting my any of the account or bank services just because I belong to any lower middle income family. So this is wrong. So always remember, it shouldn't result in the denial of any banking or financial services, especially to the general public or those who belong to the financially secluded or disadvantaged society, right? Now, if you are in the case of non-compliance of KYC guidelines, so as a customer, you are not you are not participating in this KYC norms and conditions, and you are not fulfilling the complete KYC. So this can result in the closure of the account. Bank can decide to close your account, okay, after giving you the due notice. Okay, next is the customer identification process. First, the customer is needed to be accepted, right? And what are the conditions for that? I have already told you. The second is saying that customer identification process is compulsory. So when you have presented your PAN or any of your identity claiming that whatever you are saying is correct, then bank need to verify each and every detail of you. Then it is known as customer identification procedure. Up now, the verification of the identity of the customer can be done in the following cases. First of all, if you want to open any account, you want to transfer any money to outside India for any international transfer, you have to open any account. For you, the customer identification procedure is must. Second, if you are selling any product including third party product, loading reloading of the prepaid travel card for a value of rupees over 50,000. So if you have any travel card, right, if you have any travel card and you want to recharge your travel card with a value of over rupees 550,000, okay, you are selling any third party product also and the value is over and above 50,000, then customer identification procedure is must for all of you. If you are any walk-in customer and you are carrying out any transaction or the series of transaction whose aggregate value is over and above 50,000, then CIP is compulsory for all of you. And fourth, when there is a doubt that a customer, account based or walk-in customer, intentionally is structuring any transaction below this value. So for all these customer identification procedure is must, right? Okay, now next, Next is the customer due diligence procedure. So customer due diligence means what? Customer due diligence means the overall profile checking of that customer, the overall complete verification from the address to the business to the everything. Okay, the complete due diligence is known as the customer due diligence procedure. Now, this is very important. These are the officially valid documents for the KYC. You can present passport, driving license, proof of possession, voter's identity card, job card that is offered by Narega, and there is a national population registrar also. So these are the officially valid document for KYC. Know your customer. Right? Okay. So always remember here PAN is not included. This is very important portion. Okay. Now there are some customers for whom enhanced due diligence requirement is compulsory. So if you are a high category risk customer, for you only due diligence is not enough. You have to go through the enhanced due diligence requirement. Now, for whom enhanced due diligence requirement is compulsory, for example, you are a non-face-to-face customer. Non-face-to-face customer means you haven't to visit the bank branch for any of the transaction. You have opened the account through online portal or Aadhaar. You are carrying out all the transactions in the online mode. Now your enhanced due diligence requirement is compulsory because bank haven't seen you yet. Okay, so the enhanced due diligence requirement is compulsory in this case. Okay, for politically exposed person, so if you are belonging to any political position in the foreign country, you are any foreign secretary, you are in India, but you hold the position of any foreign government once in a while, or currently you are working with any foreign government, your enhanced due diligence requirement is compulsory. Third, for any client account that is opened by the professional intermediary, so if there is any professional intermediary and that professional intermediary opened your account, your enhanced due diligence requirement is compulsory in this case. Okay, now customer level KYC and monitoring, very important. So for every customer, there is a unique customer identification code, UCIC, unique customer identification code that has been given to you for each and every customer. So this is actually the unique identity of the customer. Now this code is actually help in tracking facilities, monitor transaction, and improve risk profiling of that customer. Okay, and this code is actually helpful for avoiding the repeated KYC, because in the current scenario, if you are going to a bank, you want to open an account, but now the account is opened by you. Now if you want to add on some services, again the KYC is compulsory for you. KYC is compulsory for each and every extra service you are taking in the bank. So for avoiding that repetitive KYC requirement, always remember this code is given to you, and this code is a unique identifier of you to avoid that repetitive KYC for each and every product you are availing in the banking system. Right now, periodic updation, see, very important. So I have already told you that a customer is categorized according to a profile of the customer. The customer is identified either into a high, medium, or a low risk customer. So there are three categorization of the customer. Customer can be a high risk customer, customer can be a medium risk customer, and customer can be a low risk customer. So always remember the profile of that customer is checked. Okay, for example, there is any high risk customer, periodic updation should be done in every 2 years for this high risk customer. If you are a low risk customer, periodic updation should be done in at least every 10 years. And if you are medium risk customer, periodic updation should be done in every 8 years. For that, this is very important, the periodic updation for the risk categorization. Okay, again, a very important portion. This is again a very important portion. Central KYC record registry. Now, Central KYC record registry is actually an authorized entity formed by the government of India to receive, store, safeguard the KYC record of the customer in digital format. So, for KYC process, you are actually giving your identity, your PAN or Aadhaar or anything to the bank. So, for storing, safeguarding this whole identity of the customer in a digital format, there is a centralized authority which is actually opened by the government, which is known as the Central KYC Record Registry. Now, Government of India has actually authorized CERSAI, Central Registry of Securitization, Asset Reconstruction and Securities Interest of India, to perform the function of this Central KYC Record Registry. Clear? So this is very important for all of you. Next, record management. See, record management. So according to the Prevention of Money Laundering Act and according to the Prevention of Money Laundering rules, okay, it is must that a bank need to maintain the profile, the identity of the customer from the 5 years. So if you actually finished your accounting relationship with the bank, in this case also, a bank need to store your identity and safeguard your record for a period of complete 5 years, right? And bank need to maintain the record of the transactions also for a period of 5 years from the date of transaction. For example, I am a customer of a bank and I have deposit 1 lakh rupees in my bank account today. So from today till the period of 5 year, bank need to maintain the record of this transaction. Okay, and this is according to the Prevention of Money Laundering rules and Prevention of Money Laundering Act. Clear? So this is the important portion for the complete unit. I have just given you the important portion of the complete unit. Okay, let's do some practice question. Customer acceptance policy of a bank should state that a bank will not open an account which is operated by third person for a professional intermediary in a benami name or without a PAN. Very easy, you can all answer this question. Customer acceptance policy. Customer acceptance policy. So customer acceptance policy says that no account is open in the Benami name. So C is the correct answer here. Yes, C is the correct answer here. Okay, now this question you need to answer in the comment section of the comment box of this video comment box, among the following document which is not a officially valid document. Now this you all need to answer in the comment box of this video: PAN card, job card, letter by NPR, or proof of possession of Aadhaar number. So which of the following is not an officially valid document for the KYC purpose? Okay, so please answer this in the comment box. Now, what are the various type of customer a banker face in the banking system, and what are the operational aspects of that, or what are the steps that has been taken for what opening the account of various type of customer? Okay, done. Okay, so let's start with this. First of all, the very first and the important thing is the account of individual. If any individual is coming to you, what are the operational aspects for that individual? So an account for an individual can be opened for a single individual as well as for two or more individuals. Means the account can be opened jointly or in the single name. The individual should be major by age, should not be of unsound mind, means should or be of sound mind, should not be undischarged, insolvent, or disqualified from any law. Okay, then there is an individual which is not of sound mind or is a minor. The form may be signed by her court appointed guardian or natural guardian. So if you are an individual and if you are minor by age or if you are not of sound mind, then on your behalf the form is actually signed by your natural, either by your natural guardian or court appointed guardian. And KYC is actually compulsory for both the individual as well as the guardian. Okay. Next, if we talk about the joint account holder. Joint account holder, when the joint account is opened, the very first thing is the relationship. Before opening the joint account, you must clarify the relationship between you two or three or more who are going to have a joint account. If you are a partner, if you are husband and wife, if you are mother, father, anything, just please have the relationship described, right? And it is also advisable to know that how much funds can be flow or should be flowed in the personal account or in the joint account. For the joint account, the account opening form should be signed by all account holder. So it should be signed by all account holder, not just by one account holder. So if you are individual who is living in India and you want to open any joint account with person who is living in India, who is the resident of India, it is very easy. But if you want to open account with any NRI, okay, this is also permissible only if you have any close relationship with that NRI. Okay, so you must have a close relationship with that NRI if you want to open any joint account with any non-resident Indian. Okay, next, account of illiterate person. Now, if you are an illiterate person, then what are the criteria? The very first thing is the rules relating to the account of opening the account should be clearly explained to that individual in whatever language he or she may understood. So if he and she is an illiterate person, he can't read, right? So you have, as a banker, you have the responsibility to explain each rules and regulation to that illiterate person in whatever language he or she may understood, right? It is also advisable that for withdrawing money, each time you should come personally to the bank with the passbook. Okay, as an illiterate person, you want to withdraw any money from your bank account, you are advisable that you must come to the bank branch every time with passbook. A current account is actually not offered to the illiterate person. So an illiterate person is not eligible to open the current account. Checkbook shouldn't be issued in this case. If you are an illiterate person, your checkbook will not be issued. Your left thumb impression should be taken for the process of account opening, right? So checkbook is not given, very important. Current account is not opened, very important. Okay, and each withdrawal you should be confirming that each withdrawal orderly. Okay, so if you want to have the withdrawal, you should personally to the bank with the passbook. These are the operational aspects of the illiterate person, right? Now, if you are a blind person, again, blind person, the whole thing depends upon the satisfaction of the manager. If manager is satisfied with that blind person that yes, he or she is able to handle the account by herself or himself, the account is given to them. Blind person, passport size photograph of that blind person should be obtained, one to be attached with the account opening form and another with the passbook. Signature and thumb impression should be taken, and if the manager is satisfied, then manager may allow them to have. Okay, done. Done. Okay, next. See, now account of the minor, very important. What are the operational aspects of the account of a minor? First of all, for inculcating a saving habit in the account or for inculcating some saving habits in the individual, minor is also offered with the saving account. And if there is any minor whose age is 10 years and above, they are all allowed to open the saving account. Now, in the case of minor, Her natural guardian or court appointed guardian is the actual person who is actually conducting any thing on his or her behalf, right? Father is the natural guardian for opening the account, but RBI has permitted that opening the minor account with the mother or as a guardian is also permitted, right? The minor should be literate and a minor cannot open a joint account. So these are the conditions for the minor, right? Last is Hindu undivided family. Now, Hindu undivided family, when a Hindu dies, okay, he or she leaves what property behind or business behind. This pass on to their legal heirs or descendants, which are now considered as the Hindu undivided family, right? Now, Hindu undivided family, there is a head which is known as, who is known as Karta, and there are the other family members who are known as the co-partners. Very important, the Karta's liabilities are always unlimited, whereas the co-partners liabilities are limited to the extent of share they have in that property, right? If you want to open the account of Hindu undivided family, all the signatures of the major members of that family is necessary, right? So these are the Hindu undivided family. Now, the Karta is the eldest male child of that family. The eldest male child of that family is known as the manager or the Karta. But according to the recent rulings in the Delhi High Court, the eldest female child can also be its Karta. The eldest female child can also be its Karta. Karta's liabilities are always unlimited, whereas the co-partners' liabilities are limited to the extent of shares they have in that property, right? So we have learned about the minor, we have learned about individual, joint account, illiterate person, blind person, and Hindu undivided family. This is some of the important topic of the complete unit, but this unit is actually very lengthy. Now let us discuss some of the questions. First, introduction while opening account is optional, not to be taken discretionary or compulsory. Introduction while opening an account. Nowadays, introduction while opening the account is actually compulsory, not compulsory, optional, not to be taken, or discretionary. The correct answer is, so after the introduction of KYC, now the introduction while opening the account is completely optional. Okay, it depends upon the choice of the customer, right? So it is optional, it is not compulsory. Now this question, a minor for whom the court has appointed a guardian attains maturity on the completion of dash years, 21, 18, 15, or 17 years. Now this question you have to answer in the comment box of this video. To discuss operational aspects of deposit account, this is module A, unit 5, right? Operational aspects of deposits account. So we are going to discuss the important thing related to this chapter. Everyone just please like and share the video to the maximum you can. Okay, let's start with this topic with the very first thing, sorry, that is known as the current account. Now what is current account? You all know current account is offered to those individuals who want to have a large transaction as well as daily transaction. They have daily debits and credits. They have daily large value of transaction that they have to deal with. They have any transaction related to the business, right? So for carrying out the business transaction, for helping or facilitating the business transaction, so the current account is offered. Now current account, the very important thing is no interest is paid in the current account activity or the current account balance. So bank is not paying any interest in the current account. Now this is very important, that current account, who cannot open the current account? So the current account cannot be opened by, first of all, a minor. Okay, but in case of a minor, if a minor is given or if the minor is concerned and there is a situation in which the minor want to have a current account, they can be given if their natural guardian is actually on the behalf of that minor operating the current account. So there is a one flexibility in the current account. Current account, if offered to the minor, then it is only in the case when the natural guardian is managing that current account on his or her behalf. Pardhanasheen woman, a woman who is actually completely in veil, is not allowed to open a current account. An illiterate person is not allowed to open a current account, and a blind person is not allowed to open a current account. Now, current account, because it is daily, it is for actually daily transactional need, so no restriction on the withdrawal and deposits of the current account. Right now, second is the saving bank account. Saving bank account to inculcate saving habits in the individual. Those individual who don't want to have any large value transaction daily, those individual who don't have to do daily transactions, okay, don't have any business transaction, business need, it is just to save their own money. So to inculcate saving habit in the individual, saving bank account is offered, right? Now, saving bank account can either be opened with check facility or without check facility. Saving account is actually opened with check facility and without check facility. If we talk about the saving account, the interest is payable on the deposit in the saving account. Now, what are that interest? See, if the concern, if the criteria is given for first 1 lakh deposit, every bank has to offer a uniform interest rate. So for all the deposit up to rupees 1 lakh in the saving bank account, each bank has to offer a uniform interest rate to the customer. But for a deposit over and above 1 lakh, bank are free to decide the differential interest rate, right? So this is the saving bank account. Now, what are the eligibility to open the saving bank account? First of all, the saving bank account can be opened in a single name or in a joint name, both, right? Minor who are above 10 years are all allowed to open and operate the saving account independently. Some banks may fix a higher age for opening the saving account. Now, some banks may fix a higher age. Now, the common criteria is if you are 10 years and above, you are all allowed to open the saving bank account. Karta of a Hindu undivided family, you all know about the Karta. The last unit, I have already explained to you who is Karta, right? So, Karta of the Hindu undivided family is all about to open the saving account. Entities of the categories for which RBI has given general permission, they are all allowed to open saving account, right? Next there is a basic saving bank deposit account. Now, basic saving bank deposit account is different from the normal saving account. Basic saving bank deposit account is actually for the financial inclusion. It is for the person who belongs to the lower income category, right? For including them into the banking system, the bank is offering basic saving bank deposit account. Various free services is offered in this account, like the deposit at bank branch, ATM, electronic money transfer, depositing cash, government agencies, etc. Right? There is no limit on the number of deposits in a month. A minimum of 4 withdrawals is allowed, including ATM withdrawal. Bank can also offer a value additional services, value added services for some fee, okay, in which bank should charge some transparent fee, but it is completely optional for the customer whether they want to avail that service or not, right? Basic saving bank deposit account, if you are having this account, you don't have to maintain any minimum balance in it. Only one individual can have only one basic saving bank deposit account. And if you are holding the basic saving bank deposit account, you are not allowed to hold any other saving bank account. And if you have any saving bank account, within opening a PSPTA account 30 days, within 30 days, you need to stop this basic saving or this other SB account or saving bank account. This is known as basic saving bank deposit account. Last thing is FDs, fixed deposit. Now, fixed deposit, again, when the deposits are made, and this is actually withdrawal or withdrawn after a particular maturity. Okay, when there is a time period that is involved with the deposit, that is known as the fixed deposit or term deposit. The minimum time period that is allowed is 7 days, and the maximum time period for which you can have an FD is 120 month. Now, if you are have an FD of rupees 3 crore and above in case of scheduled commercial bank, okay, other than RRBs and small finance bank. So if you have an FD of rupees 3 crore and above in scheduled commercial bank and small finance bank, and in case of RRB, if you have an FD of 15 lakhs and above, these are considered as the bulk deposit. Very important, right? Now, bank can offer differential interest rate in the FDs also. Bank can offer this term deposit with premature withdrawal facility as well as without premature withdrawal facility. But if you have an FD of 15 lakhs and below, bank must offer you this with the premature withdrawal facility, right? So always remember, current account, there is no interest that has been paid. Saving account, yes, interest has been paid for up to 1 lakh, uniform interest rate. Over and above 1 lakh, bank are free to determine their own interest rate, right? And for the FDs, yes, if you are having an FD, yes, the interest rate is offered and it has a lot, comparatively more than the saving account. You will get more than the saving account if you are holding your deposit in the FD, right? So this is the chapter, the most important units of the chapter. Let's discuss some of the question. The very first question is, a current account cannot be operated by woman, individual, illiterate person, or a non-resident. Very easy. A current account is not or cannot be operated by everyone. A current account cannot be operated by, yes, a current account cannot be operated by an illiterate person. So categories: illiterate, blind, Pardanashin woman, and minor. Okay, current account is not offered to them. A minor age dash years or more is allowed to operate a saving bank account independently. A minor who age dash years or more is allowed to operate the saving bank account independently. So if you are a minor and your age is 10 years and above, you are all allowed to have the saving bank account to operate it. This module A, unit 6, that is operational aspects of handling cash, checks, etc. So we are going to discuss the most important part or the most important concept related to this unit. Everyone, kindly just please comment in the video that everything is working fine for all of you, and please everyone just please like and share the video to the maximum you can. Okay, so let's start with the operational aspect with this chapter. The very important thing of this chapter is check truncation system. Now, check truncation system. What is this mean? Check truncation system. Check truncation system means to eliminate the physical movement of check in the complete clearing process, and to eliminate it with what? With the scanned image of the check. Then the process is known as the check truncation system. When the scanned image of the check is regulated or it is flowed through the complete clearing process of the check, okay, which is actually to eliminate, the object is to eliminate the need for the movement of the physical movement of the check in the complete clearing process, then it is known as the check truncation system. So RBI has introduced this CTS system for the interbank clearance of the check without their physical movement. Okay, check truncation. So truncation is the process of stopping the flow of physical check. So the physical check is being stopped. The flow of physical check is stopped, and the physical check is actually replaced by what? Replaced by the scanned image of the check. Then it is known as the check truncation system. Now, what are the characteristics characteristics of the check truncation system. What are the characteristics? First of all, it is an electronic image of the paper check, right? Now, in this, only the clearing house or the bank who are involved in this CTS process are allowed to scan the image of the check, right? The electronic image of the check truncation system truncate from the point and the time of truncation onward. Truncation is done only during the clearing cycle process, right? After the check is being truncated, the paper check is kept with the clearing house in the safe custody. Now, if you want to add the digital signature in the check truncation system, it is completely optional. It is not mandatory. So you can add the digital signature in the check truncation system, but it is completely optional. It is not compulsory. So it is an electronic image. Okay, it is the electronic image of the check, right? It is only truncated in the clearing cycle time. Okay, done. Now, what are the clearing cycle process or CTS process? So if we talk about the process flow of the check truncation system, the very first is the presenting bank. Present bank, for each check, presenting bank or branch captures the data and the image of the check either at the branch level or at the service branch. So the very first thing is the presenting bank. Presenting bank, the objective of the presenting bank is to stamp the image of the paper check and make it or infused it into the clearing cycle process, right? Now, after this presenting bank, there is a presentation clearing or the clearing house. Objective of clearing house is to what? Is to check the image, whatever the data they have received, that process the data, arrive at a settlement figure and route the image to the paying bank. Now, the third is the paying bank. Now, paying bank, when they received all the data from the clearing house, if everything is good and paying bank is satisfied with the scanned image, paying bank settle out the payment. And if not satisfied, paying bank just have a return clearing session. Now, return clearing session, if paying bank is not satisfied with the image quality or anything, paying bank return it to the clearing house and clearing house return it to the presentation bank. Okay, so this is known as the presentation cycle and this is known as the return cycle, and presentation cycle plus return cycle is known as the clearing cycle, one complete clearing cycle. So again, I am telling you, please listen. There is a presentation bank. The main objective of the presentation batch is to receive the check, scan the image and infused it into the clearing process and forward it to the clearing house. Clearing house, when received the image, processes the data, arrive at the settlement figure and enroute it to the paying bank. If paying bank is satisfied with all the thing, paying bank settle off the payment, and if not satisfied, paying bank create a return cycle. Now, what is this return cycle? If not satisfied, paying bank sent back this check to the clearing house and clearing house sent back this check to the presentation bank. So this is the presenting cycle and this is the return cycle, and both together is known as one complete clearing cycle. Return cycle, because the paying bank is not satisfied, they return back the check. Now, settlement, if everything is good, paying bank settle out the check completely, right? Now, clearing cycle, there is a one presentation cycle and one return clearing cycle per day, and the both together is known as the clearing cycle. Now, there are security feature. Obviously, there are different security feature that has been added in this complete process, like end-to-end public key infrastructure, so as to maintain the privacy of the data or the leakage of the data. Endorsement at the time of scanning. When you have scanned the image of the check, a single line is endorsed at the back of the check, which is the unique identifier for that instrument. This is known as the complete check truncation system process flow. Clear? Now, what are the images? How many images you have to take in this CTS system? So in CTS system, there is a combination of grayscale and black and white image. So you have to take technically three image: front grayscale, front black and white, and back black and white, right? Now images of this check is taken by using of a specific scanners, not any simple phone. Images that do not meet the specifications are rejected. There is a rigorous quality check with image quality assessment at different level. If not satisfied with the image quality, the paying bank can demand the physical check also. Clear? And there is a public key infrastructure for data and image security in the complete process. Okay, so this is the important thing related to this chapter. Check truncation system is the most important thing related to this chapter. Now there are some questions which you need to practice. Everyone please answer. The very first question is, under the CTS process, how many images is or are to be taken for each check? 2, 1, 3 or 4? You can all answer this question. Everyone, you can all answer this question. Under the CTS process, dash images is or are is to be taken for each check. 2, 1, 3 or 4? Everyone please answer this question. So yes, there are three images that need to be taken: the front grayscale, the front black and white, and the back black and white image, right? Next, okay, which of the following statement is not acceptable in the check collection policy of a bank? Very easy. Not acceptable in the check collection policy bank. First, bank will take all possible measure for safeguarding. Yes, it is. The bank will compensate the customer for any delay. Yes, this is the collection policy. The bank will not be responsible for any delay. Yes, but if you said that no compensation will be paid for the check, it is wrong. So, compensation is to be paid if there is what? If there is a delay in the collection of the local check. So D is the correct answer here, because this is not acceptable in the check. Unit 7 PPB Module A, a very important chapter as well as a very easy and short chapter. Let's start discussing this chapter. The very first thing of this chapter is mandate. Now, what is a mandate? Mandate is an authority which is given by one person in favor of another person to do or to act on his or her behalf. That is known as a mandate, right? So mandate is what? A letter, or mandate is just authority given by one person to another person, which is called as mandatee, that now you are responsible for to carry out certain acts on his or her behalf. That is known as mandate, right? Now, if we talk about the mandate, the person who is given the authority is called as mandatee. A very important thing is a mandate is an unstamped agreement. Okay. So while issuing mandate, you need not take any stamp on this agreement. It is an unstamped agreement. It is comparatively for a shorter period of time because it is issued for carrying out some specific function or act on your behalf. So it is comparatively for a shorter period of time. That is known as mandate. But if we talk about the power of attorney, power of attorney, again the same thing. Technically, it is the same thing with differences, of course. Power of attorney is again a letter, or you can say a document executed by the principal, okay, or you can say donor on behalf of donee, or on favor of donee, or you can say agent, and you authorizing that person that now you are responsible for acting completely on my behalf. When I'm authorizing anyone that you are now responsible for what? Acting completely on my behalf, then it is known as what? Then it is known as power of attorney. Now, what is the difference between mandate and power of attorney? See, If we talk about the mandate, mandate is for carrying out some specific act, right? Whereas power of attorney is given when you are giving the authority that to another person, that you are now completely responsible for acting on my behalf. Second, mandate is for comparatively for a shorter period of time, whereas power of attorney is for a longer period of time. Power of attorney is for a longer period of time, whereas mandate is for a shorter period of time. Okay. The person who is receiving authority in mandate is called as the mandatee, whereas the person who is receiving authority in power of attorney is called as the donee or is called as the agent, right? Very important difference. A mandate is an unstamped agreement. You don't have to take a stamp on mandate, whereas power of attorney is a stamped agreement. Mandate is comparatively for a short period of time, whereas power of attorney is for a longer period of time. So this is the difference between power of attorney and mandate. Okay. Now, if we talk about the banker's lien, now what are the rights of the banker? So first of all, there's a banker's lien. What is a banker's lien? Banker's lien is the right of the banker that bank has the right to retain the possession of the good until the debt of the debtor is fully paid. For example, I have taken some gold loan from the bank, right? Now, in this case, I do what? In this case, I just given gold as a collateral to bank and I have received loan in this case, right? Now, bank has all the right to retain the possession of my gold until I fully pay off the debt. This is known as banker's lien. And banker's lien can be specific or it can be general. Okay, so particular banker's lien means you bank has to take the possession of that particular good which you have given as a collateral while borrowing the loan. Whereas generally bank can take the possession of any good, not just that specific good. Bank can take the possession of any good until the debt of the debtor is fully paid. Okay, so this is known as the banker's lien. Okay, next thing. Next thing is right to set off. Right to set off. For example, you have two accounts in the same bank. One account shows a debit balance and another account shows a credit balance. Now, bank has the right to set off your debit balance with credit balance of another account. This is known as right to set off. For example, you have some 100 rupees as a debit in one account and you have 500 rupees as a credit in another account. So bank has the right to what? To set off your debit balance of rupees 100 with the credit balance of rupees 500. Now you have left only 400 in that account and in this account you have the zero balance. This is known as right set off. Okay. Now, last thing is right of appropriation. Now, what is the right of appropriation? Right of appropriation says that when you have deposited some money, right? When you have deposited some money in the bank account and you haven't given any instruction in this case to the bank that this money is for some specific task, right? Now, bank has all the right. If you have some pending EMIs and if you have some pending loan, bank has all the right to set off this with the credit balance. Okay, so whatever you have credit, because you haven't given any instruction for the usage of that money, so bank has the right, bank has executed his right and they set off the loan amount or the pending EMI with the money, with whatever the money you have given or you have credited in that. That is known as right of appropriation. Clear? So there is power of attorney, there is mandate, there is right to set off, right of appropriation, and right to banker's lien. Okay, this unit 8 of PPP, that is foreign exchange remittance facilities for individual. Foreign exchange remittance facilities for individual. This is lecture 8 or unit 8 of PPB module A. So we are going to discuss the most important thing related to this unit. Okay, the very first thing, let's start discussing with the very first thing, that is known as FEMA, Foreign Exchange Management Act. Okay, now FEMA, if we talk about the Foreign Exchange Management Act, so in India, as I have already told you that before 1991, we have a lot of restrictive policies in the foreign exchange field. And at that time, the policies were so that we have to just preserve this foreign exchange reserve because it was a very limited resource for us individual or for us Indians, right? And at that time, the foreign exchange was actually controlled by the defense of India. Later, with the significant changes, now the changes has been introduced, and after that, there has been act which has been introduced. Just a second. Okay, so there has been act which has been introduced, which is known as the Foreign Exchange Management Act. Now, Foreign Exchange Management Act actually replaces the earlier act, which was known as FERA. So earlier there was an act which was formed to conserve the foreign exchange, and that act was known as the FERA, Foreign Exchange Regulation Act. Then FERA has been replaced with FEMA, Foreign Exchange Management Act, right? Okay, next, if we talk about the FEMA, Foreign Exchange Management Act, under the Foreign Exchange Management Act, all the transactions are divided either into the capital account transaction or the current account transaction. Now, what is the capital account transaction and what is the current account transaction? So, current account transaction means any transaction if it neither affecting any financial liabilities of the country nor it affecting any assets of the country, then it is known as the current account transaction. So if India is involving in any type of foreign exchange with another country, but this transaction doesn't increase any financial burden on the country or decrease any financial burden of country, means there is no change in the financial liabilities of the country, as well as if there is any transaction which neither affect transaction the assets of the country, then it is known as the current account transaction. So current account transaction, the example is like you have to pay in connection of any foreign trade, there is expenses in connection of foreign travel, education, etc. So these are all coming under the current account transaction because it is not nor affecting the financial liabilities nor it is affecting the assets of the country. But if we talk about the capital account transaction, what are the capital account transaction? So capital account transaction are those transaction in which either there is any increase or decrease in the financial assets of the country or there is any increase and decrease in the financial liability of the country. For example, India is borrowing loan from the World Bank. This loan is capital account transaction. Why? Because it actually increases the financial burden of the country. So if there is any transaction which actually affect the financial liability of the country or it is affecting any assets of the country, then it is known as the capital account transaction. And if we talk about the capital account transaction, if you are engaging in the investment in foreign securities, you are acquiring some immovable property outside India, these are all considered as the capital account transaction. And if we talk about FEMA, Foreign Exchange Management Act, Foreign Exchange Management Act actually gives a central government the permission to impose restriction on current account transaction, and it gives RBI the permission to impose restriction on capital account transactions. So these are two things. So FEMA has authorized Reserve Bank of India to impose restriction on the capital account transaction, whereas the RBI, the FEMA has given government the power to impose restriction on the current account transaction of the country. right? Now, what are the resident Indian? So, according to FEMA, what are the resident Indian? So, a resident Indian is defined under Section 2V of the Foreign Exchange Management Act, right? 1999. Now, what is this resident Indian? So, the very first and the important thing that bearing some exceptions, if you are a person who is residing in India for a period of more than 182 days in preceding financial year, then you are considered as the person resident in India. You are any person or anybody if you are registered or you have established yourself or incorporated in India, then you are considered as the resident Indian. For example, you are any person living outside India. You are a person living outside India, but you hold any office, branch, or agency that is in India. But you are living outside India, then also this office or branch or agency is considered as the resident Indian. If there is any office or branch or agency controlled and owned by the person resident in India. So these are the four category in which define the scope of the people who are considered as the resident Indian. And in this, the very important thing is 182 days. So if in the preceding financial year, any individual who is living in India for a period of more than 182 days, then he or she is considered as the resident Indians according to FEMA condition, right? Now, next, person of Indian origin. Now, who is considered as the person of Indian origin? A person of Indian origin is any citizen who is living outside India except in the countries like Pakistan or any other country which is notified by the central government, and they are fulfilling these conditions, then they are considered as the person of Indian origin. First of all, who was a citizen of India by the virtue of Constitution or the Citizenship Act. If you are by the Citizenship Act or Constitution, you are the citizen of India. Second, you belong to a territory that becomes the part of India after the independence, after we got independence, who is a child, great grandchild, or grandchild of the citizen of India, and who is the spouse of any foreign origin of the citizen or spouse of any of the person referring to A, B, and C. So, if you are following all these conditions and you are living in any other foreign country except Pakistan and whatever the countries which is notified by the central government, then you are considered as the person of Indian origin as per the FEMA, right? Now, why FEMA has been replaced with uh, why FERA has been replaced with FEMA? What are the difference between these two? Hi, Salochna. Good afternoon. So first of all, if we talk about the act of enactment, FERA, which was earlier act, okay, this was earlier valid and this is currently valid, right? So if we talk about the FERA, FERA was passed in 1974 and it actually started in 2000. Second, if we talk about FERA, FERA has 81 sections, okay, whereas FEMA has 49 sections. FERA, the main objective behind FERA was to conserve the foreign exchange reserve. It was actually a restrictive act which aims to conserve the foreign exchange reserve, whereas FEMA was there promote the foreign payments and trade and enhance the foreign exchange reserve in India. Second, if we talk about this FERA was a conservative act, but this is more flexible act. Here, if you are staying in India for a period of 6 months in a preceding financial year, then you are considered as resident Indian. But according to FEMA, if you are living for more than 182 days, then you are considered as the what? Then you are considered as the resident Indian. Violation, if you violated any rules of FERA, it is regarded as a criminal offense. But in FEMA, it is regarded as a civil offense. Clear? The Unit 9 of PPB Module A, that is operational aspects of NRI business. So in this chapter, we are going to learn about the most important accounts which are offered to any NRI or person of Indian origin. Very important chapter, but I am going to discuss the most important topic related to this unit. So, what are the special types of account which has been offered to NRI and person of Indian origin? So, the three most common type of account that has been offered to NRI and PIO is NRE, NRO, and FCNRB account. So let us discuss one by one each of the account. First, there is NRE account. NRE is non-resident external rupee account. NRE account is non-resident external rupee account. First of all, it is maintained or it is given to those individuals who are NRIs and the person of Indian origin, right? Now, what type of account is there? So this is can be saving, current, recurring, FD account. Now, for what purpose specifically this NRE account is offered to you? So NRE account is offered for transferring your foreign earnings to India. So for example, you want to transfer your money, you are living abroad, you want to transfer some of the earning regularly to any of your relative who are living in India, to your mother, father, anyone, right? So for carrying out these transactions, for transferring your foreign earnings to here, to India, so the account which is offered to you is the non-resident external rupee account. Joint accounts are permitted. So if you are two or more NRI or two or more PIO, and if you are an NRI or PIO who want to open a joint account with the relative resident in India, all are allowed. Okay, so in this joint account facilities are allowed. Now, FD is also offered to NRE account, and the minimum tenure for FDs or term deposit in NRE account is 1 year. Okay, interest rate depends upon how much deposit you have deposit in this NRE account, whether it is a bulk deposit or not. Depending upon that, interest rate is variable, right? Additional interest rate is not permitted. So there's no additional interest rate for senior citizen or for the staff in the NRE account. Okay, so premature withdrawal of term deposit is allowed subject to the certain penalty. This is the NRE, non-resident external rupee account. The main purpose is if you are an NRI and you want to transfer your foreign earnings to India, for this, the account which is especially offered to you is known as the non-resident external rupee account. Now, there is a next type of account also, which is known as NRO, non-resident ordinary account. So, again, it is offered to PIO or NRI. Okay, for which purpose it is offered? So if you are a resident Indian and you have some transactions which are denominated in Indian rupee, you are living abroad, you are an NRI, you are an PIO, but you have a transaction, you have to do transaction daily which are denominated in Indian rupees, or you have some earnings in India, you have some property in India, you have given it on a rent, and you have to receive a monthly rent on this property. Now, for managing these type of earning, there is non-resident external ordinary account, non-resident ordinary account which has been offered. Now, this type of account can be saving, current, recurring, and term deposit. Here, the tenure of term deposit is 7 days, minimum tenure. So in NRE, the minimum tenure is 1 year, whereas in NRO account, the minimum tenure for the term deposit is 7 days, right? Now, interest rate, again, it depends upon how much deposit you have deposit in that account. It is bulk or not, depending upon that, each individual customer has the differential interest rate that can be offered to them by the bank, right? Now, if we talk about the ceiling rate means the rate cannot be higher than the domestic Indian rupee term deposit interest rate. So whatever that bank is offering to Indian citizens in Indian rupee, the interest rate, that shouldn't be exceeding that interest rate. So obviously you have to give less to the NRO account. Okay, additional interest rate is not allowed. So no additional interest rate for the senior citizen, for the staff in the non-resident ordinary account. Now next, if we talk about the non-resident ordinary account, what are the permissible credits and what are the permissible debit in the non-resident ordinary account? So if we talk about the permissible credit, first, inward remittances from outside India. Okay, so you can remit to India from outside India, allowed. If you have some dues in India, this can be credited in this NRO account. If you have to transfer from any NRO account to your NRO account, it is allowed. Rupee and gift, but of course under the liberalized remittance scheme, this is all these are all the permissible credit in the non-resident ordinary account. What are the debits? So local payments are allowed. Okay, so yahan par in this the remittance abroad is not permitted. So these are the permissible credits and debits in the NRO, non-resident ordinary account. Loans, if we talk about the loans, yes, loans is provided against the fund which are deposited in the NRO account, but specifically this loan cannot be used for relending or agriculture or plantation activities. See, agriculture, plantation, relending and real estate business, these loan cannot be used for specifically these purpose. Okay, now if we talk about the difference between the NRE and NRO account. What is the difference between NRE and NRO account? The very first is the full form, a non-resident external account. This is non-resident ordinary account. Second, if we talk about this NRE, it is an account and NRI to transfer foreign earnings to India. So it is actually to transfer your foreign earnings to India. And this NRO account is to manage your income earned in India. If we talk about NRE, interest earned is taxable free. Here, interest earned is taxable. The fund in NRE can easily be repatriated outside India, whereas in NRO, yes, it is repatriated outside, but within a certain limits. Okay, joint account, yes, NRE account can be opened by 2 or more NRIs, whereas the NRE account can be opened by NRI account with the resident Indian or the Indian citizen. If we talk about the deposits and withdrawal, in NRE account, the money can be deposited in foreign currency and withdrawal in Indian currency. Whereas here, it can be deposited in foreign and Indian currency both, but the withdrawal can be only in Indian currency. It is prone to risk, it is not prone to risk. So these are the difference between the NRE and NRO account. The next very important type of account is FCNRB account, foreign currency non-resident account scheme, FCNRB account. So if you are an NRI and you wish to have a FD in India where you can deposit the money in the same currency you have earned. For example, you are living in USA, you are earning in dollar and you want to have an FD in India, but it should be in dollar only. Then the account which is offered to you is known as the FCNRB account, foreign currency non-resident account bank scheme, right? So it is an excellent investment option for an NRI if you want to save in India, but in the same currency you have earned, right? So this is offered to you. FCNRB account, always remember, it is a term deposit account. It is not a saving account. It is not a current account. It is only a term deposit account. Clear? So if we talk about the tenure of term deposit here, so minimum you can have an FD of 1 year, maximum you can hold it for 5 years, and there are blocks like 1 year and above but less than 2 years. There is 2 years and above but less than 3 years. There are 3 years and above but less than 4 years, 4 years and above but less than 5 years, and there is a 5 year. These are the tenure of the deposit. Clear? Now I am giving you one question from this whole unit. You have to answer it in the comment section. So there is a comment section already which is given to you in this after ending this session. When I end this session, there will be a comment section for you all. You have to answer this question in that comment section. Funds in dash cannot be freely repartited outside India. Now you have to answer it. It is NRE, NRO, FCNRB account or SNRR account. Discuss the unit 10 of PPB, that is foreign currency account for resident and other respects. See, in the last unit, we have discussed about those accounts which are offered to NRIs and person of Indian origin. So if you are a NRI and if you are a person of Indian origin, what types of account has been offered to you as this, right? But in this, we are going to discuss about those account which has been offered to Indian resident. So if you are a resident of India and you are trading or you have a transaction denominated in foreign currencies, what type of foreign currency account you can hold in India as well as outside India. So this is we are going to discuss in this chapter. So different type of account which we are going to discuss in this chapter is the exchange earner foreign currency account, means EEFC account, the RFC resident foreign currency account, the resident foreign currency domestic account RFCD account, and there is a diamond dollar account, means DT account, right? So these are the four different type of account that has been offered to the resident Indian if they want to hold any foreign currency account. So let's start discussing with the very first account, that is known as the EEFC account. So before starting this EEFC account, there are some general provisions for holding these type of accounts. What are these general provision? First, otherwise in unless stated, this account or these accounts can be current, saving or term deposit account. So either this account can be offered in the form of current or in the saving or in the term deposit account. Clear? So this account is not offered in the recurring deposit account, and this account can be in single or can be offered in joint name. Okay, so this is can be single name or this offered or this account can be offered in a joint name. Now in the case of the death of the account holder, you are a resident Indian. In case of the death of the account holder, now what can be the process for the disposal of the fund? So first of thing is, if you have made any nominee residing outside India, so the fund is transferred to the nominee which is outside India or who is outside India to the part of his or her shares, okay, of this account. First thing. Second, if you have made a nominee which is a resident Indian, now the fund has been transferred to them, and now if that person want to transfer any part of the fund to abroad or to any of the foreign country for meeting the liability of the deceased person. Now, this is specifically needs RBI's approval, Reserve Bank of India's approval. Third, a resident nominee of the account held outside India has to close the account and bring the proceed to India through banking channel. So, if there is any account, foreign currency account that that deceased person hold outside India, now what should be done? Now in this case, that account need to be closed and the nominee resident of India has to bring that fund inside India. Okay, so these are the general provisions for what these are the general provisions for managing this foreign currency account, right? So unless and otherwise stated, this can be current, this can be saving, and this can be term deposit account. Recurring deposit account is not allowed in this, right? Now next, if we talk about the EFC account, exchange earner foreign currency account. Now exchange earner foreign currency account can be opened by a person who are a resident of India and they are essentially engaged in managing their foreign exchange earning. So you have any foreign exchange earning, okay, you have to manage that foreign exchange earning, and you are a resident Indian. So the account which is offered to you for managing your foreign exchange earnings, that account is known as EEFC account, that is exchange earner foreign currency account. Now there are different permitted credits and there are different permitted debits under the foreign currency account. Permitted credit, first of all, 100% foreign exchange earnings by the way of inward remittances are allowed. Payment can be received for counter trade. Advance remittance can be received through export and import of goods and export of goods and services. If you have earned any professional fees like director fees, consultancy fees, honorarium. Honorarium is a small token amount that has been given or paid when you are giving any free services, right? Interest earned on the fund held in this account, disinvestment proceeds like ADR, American Depository Receipt, or Global Depository Receipt. So these are the permitted credits. So these are some of the permitted credits under this exchange earner foreign currency account. Now, if we talk about the permitted debits, so these are some of the permitted debits. The first debit is payment outside India for capital and current account transactions. So in this case, the payment you can pay outside India for capital or current account transaction. Payment in foreign exchange for the good purchase for 100% export oriented unit. Payment of custom duty, you can use this balance for paying any custom duty or taxes in India. Trade related loan, if there is any trade related loan, then debits can be used for fulfilling or for the repayment of these loans. And payment in foreign exchange to a person resident in India for the supply of any goods and services. So these are some of the permitted debits and credits under the exchange earner foreign currency account. Specifically, the purpose is you are a resident Indian and you have foreign exchange earnings, right? And you have to manage that foreign exchange earning. So for managing your these foreign exchange earning, the type of account which is offered to you is known as EEFC account, right? Next, other condition for holding this account, first of all, withdrawal in rupees are allowed, but you are not allowed to recredit this amount. Okay, now this is a current account, so it is a non-interest bearing account. There, the claim by any export credit guarantee corporation or insurance company, it cannot be credited under this account. Fund and non-fund credit based facility should not be granted against these balance, and this cannot be used for repay banking credit advances. So these are some of the other conditions for holding this EEFC account. Clear? So these are the other conditions. Next. Now, RFC account, resident foreign currency account. Now, what are the purpose for holding this resident foreign currency account, right? So first, if we talk about the resident foreign currency account, you are any individual who have lived outside India and now you are intended to move to India. You have the intention to live or settle in India. Obviously, you have worked abroad, you have employer there, okay, you have earnings there. So for managing these transactions, the account which is offered to you is known as RFC account, resident foreign currency account. Okay, so uh, if you are an NRI but you have intended to return back to India, you want to live in India, okay, and you have an intention to live in India and you want to have the foreign currency account here, you want to manage your dues from India, the type of account which is offered to you is known as the RFC account. And these are the permitted credits and debits under this account. First, you can receive any pension or monetary benefit from your employer outside India. If you have converted any of your assets into cash, you can bring that proceeds to India. Before July 8, 1947, you have any income arising and held outside India. Now, this needs RBI's special permission. By RBI's special permission, you can remit this income also to India. Proceeds of LIC claim maturity or surrendered value, this can be credited in this account. Now, what are the permitted debits? So, if we are talking about the permitted debits, so all the balance in this RFC account can be utilized for payment outside India or can be utilized towards any transaction outside India, and this can be converted into Indian rupees also. So these are the permitted credits and these are the permitted debits under RFC account. Now, RFC, but there is another account which is known as RFCD account. RFCD account is resident foreign currency domestic account. Now, what are these accounts? Now, first of all, these account can be held only by individual. It cannot be opened in joint name or on the behalf of minor. So, if we are talking about this RFCD account, it is maintained in the form of current account and no interest is payable on these type of account. RFCD account is actually meeting your need for assessing foreign currency frequently without any hassle. So it is an account with balance held in foreign currency. So if you are an Indian, okay, and you have foreign earnings and you want to maintain or manage your foreign earnings in that foreign currency only, you don't want to convert it into Indian currency, but you are living in India, but you want that, okay, my balance should be held in that foreign currency only, okay, and I need to manage that foreign currency also. The amount which is the account which is offered to me is known as RFC, resident foreign currency domestic account. Okay, now this account can be opened in 3 currencies and the currencies can be dollar, euro and pound. You can retain your foreign earnings in the same foreign currency you have earned it. Now these are some permitted credits and debits under this account. Okay, now last account is DDA, Diamond Dollar Account Scheme. Now, what is a Diamond Dollar Account Scheme? So, see, if you are any firm, if you are any corporate, okay, and you are engaged in the buying and selling of polished, unpolished diamond, rough or cut diamond, right? You are jewelry, diamond jewelry, or any meenakari or any stud jewelries, okay? If you are engaged in any these type of services, okay, the firms and the companies are eligible for this. Okay, if you are engaged in any of these transactions and you are engaged in this trade for a complete 3 years time period, means you have a track record in this occupation for a complete 3 year and you have a average annual turnover of rupees 5 crore in the last 3 preceding financial year. If you are satisfying these conditions, then the account which is offered to you is known as the Diamond Dollar account, right? And Diamond Dollar account, it is a current account, means it is a non-interest bearing account. It is a current account, means no interest is paid under this account. Okay, now let us discuss some of the practice questions related to this. Okay, the first question is what? Foreign currency denominated accounts maintained in India cannot be in the form of dash. Everyone please answer this question. Okay, foreign currency denominated account maintained in India can be in the form of dash. So if we talk about the foreign currency account can be current, can be saving, can be term deposit. It cannot be recurring deposit, right? So D is the correct answer. Thus, the cash management services and its importance. This is Unit 11 PPB Module A. So let's start discussing this topic with the very first thing. Okay, what is cash management? Let's talk about the introduction. What is cash management? So cash management refers to the collection, concentration and disbursement of the cash. Cash management is what? Cash management means collection, the concentration plus how you are disbursing this cash. The complete process is known as cash management. Cash management doesn't only deal with how you are collecting cash. It is collection plus your concentration plus how you disburse this cash. Complete process is known as the cash management system. Now, if we talk about the main objective behind the cash management, what is the main objective behind the cash management? So the main objective, the crucial job of the cash management is actually optimization of liquidity. What is this optimization of liquidity? Optimization of liquidity means your fund should be available to meet your financial obligation. The very first thing is, if you are in need, your funds should be available for meeting your own financial obligation. Plus, whatever the funds you have, the fund should be invested in a good income generating opportunities. Okay, so optimization of liquidity is the most important thing behind the cash management. So if I am talking about myself, okay, for example, I'm earning some money, right? Now, if I am just keeping all my money in my house and in idle position, there is no investment from that. So it's one thing which is I have done. I have my cash to meet my financial obligation. But the second thing, there is no disbursement of cash. I haven't made any investment. So this is not cash management. Cash management says that how you are earning the incoming, plus you should have some money to meet your financial obligation, means I should have some savings to meet my own financial obligations, plus the some money should be invested in some of the income generated opportunities. So this complete process, okay, the collection, the concentration in the form of saving, the disbursement in the form of investment, complete process, optimization of liquidity, that is known as the cash management. This is known as what? Cash management. Okay, now if we talk about the developments in the cash management system, yes, over the first few years there has been different trends which has been seen. There has been different you can say different changes in the cash management system that has been done. So cash management system has actually changed significantly over the past few decades for some of the reasons. Now the reasons are, first, there has been upward trend in the interest rate that increase the opportunity cost of holding cash. So if we are talking about the recent year, in recent year the investments is actually are giving you more interest. The investments are giving you more return, right? So when the investments are giving you more interest, when the investments are giving you more and more return, means now you have opportunity cost of holding cash that is increasing. What is opportunity cost? The cost which you are compromising. Okay, so if you are keeping your cash in the ideal position in the home, right, instead you are investing this cash into an investment opportunity, this will provide you interest. So if you keep your cash in the ideal position, you will lose that money what you should have or can earn if you have invested that money into the investment opportunity. So when you are receiving more from the investment, obviously your amount, your opportunity cost of holding that cash increases if you are keeping that cash in the ideal position. The very first thing. The second thing is technological development. So if we are talking about the technological development, so in the electronic fund transfer mechanism, there have been technological advancement that has been given by the banks. Bank has introduced NEFT, RTGS, electronic benefit transfer, NACH. There are different technological advancement that the bank has actually provided in the cash management system. So because of these two reasons, cash management has been changed significantly over the past few years. There has been introduction of computerized settled of clearing transaction. First, there was magnetic in transfer recognition. There are provision of intercity clearing facility. There are high value clearing facility, there are electronic clearing services, there are NEFT that has been introduced, there are RTGS that has been introduced. So these are some of the important technological changes that has been introduced in the development of what cash management services, right? Now, there has been different new products also that the bank is offering in the cash management services. A number of bank in India are offering a wide ranges of cash management services. All the categories of bank, including the public sector bank, old private, new generation private banks, small finance, payment bank, foreign banks in India, they are active in the cash management system. Yes, because banks are now providing different type of cash management services to cater the need of their clients. So what are project that has been offered in this cash management services? First product is the cash collection service. Bank has implemented various customized cash pickup solution to meet a specific requirement of their customer. These solution provides various benefits like minimization of operational risk, there is reduction of cost, security, increased efficiency. So this is actually the cash collection services. This is actually what? This is actually the cash collection services. So cash collection services, now you as a customer don't need to go to bank with cash to submit dash cash. No, you don't have to go, right? Why? Because now there has been cash pickup services that has been provided by the bank, which actually reduce their operational risk, which actually help in the reduction of cost, security. It actually increased efficiency. Okay, so this is the cash management services, cash collection services. Second is direct credit by fund transfer. Now, what are direct credit by the fund transfer which has been offered? So there are different fund transfer solution that the bank is providing. For example, there is Oliveboard. Now, Oliveboard want to transfer salary of 100 of employees, okay, at once. Now they don't go to each employee personally and hand over cash to each employee. No, instead of that, they are using the cash transfer facility, or they use the direct credit facility which has been provided by the bank. Okay, so in this, the salary has been paid. Okay, there is a supply payment change, overseas remittance. These are the different type of cash uh, transfer services that has been offered by the bank. Next, there are checks and DDs. Okay, yes. For example, you are sitting in any one of the state, right? And you want to take admission in another state. You have to submit the college fees. Now you don't have to go there personally to submit the admission fees. You can easily do so by what? By just depositing the demand draft, right? So checks and demand draft facility that has been introduced in the cash management services. NEFT, National Electronic Fund Transfer. This give you quick transfer of the payment from one bank account to another bank account. This is again a cash management services that the bank is offering you. You have cash check collection and receivable managers. Means now the check collections facility is also provided by the bank. You don't have to go personally to the bank for collecting the check. The check collection facility is offered by the bank. Right now, the bank has used the check truncation system in this check clearing system, so as to reduce the operational time of clearing of the check. So this is again a cash management services. NACH payment facility, auto sweeping facility means when your fund is transferred, auto sweep from one income generating activity to another higher income generating facility. That is the auto sweeping facility. So these are some of the cash management services that the bank is offering you. So first of all, what is cash management? It is actually the concentration, disbursement, and the incoming or collection of the check. Complete process is the cash management. The main objective of cash management is the optimization of liquidity. And you know, there have been different technological changes that has been introduced by the bank in the cash management services. Like there is NACH facility, there is the NEFT, there is RTGS. There are different type of trends that has been introduced by the bank in especially technology to increase the cash management services in for their customer, right? Clear? Done. So this is it. This is the short chapter. Now let's start discussing some practice question. Okay. So let's start discussing some of the practice question. The very first thing is, which of the following denotes the cash management services? Which of the following denotes the cash management service? Holding minimum cash at branch, providing adequate cash at ATM, providing solution to optimize liquidity, or none of the above. Which of the following actually denotes the cash management service? Everyone, please answer this question. Which of the following actually denotes the cash management services? Everyone, please answer this question. The correct answer is what? Everyone, please answer this question, guys. Okay, so very easy. Optimization of liquidity, providing solution to optimize the liquidity of the corporate. This is actually the best definition for the cash management service. Okay, now firm cash program aimed at accelerating cash inflow and controlling cash outflow. Accelerating cash inflow and controlling cash outflow. This is true or false? A firm's cash program is aimed at accelerating cash inflow and controlling cash outflow. This is true or this is false? So the correct answer is true, right? So this is the complete chapter. Discuss Unit 12 of PPB Module A, and the topic name is Payment and Collection of Check and Other Negotiable Instrument, right? So in this chapter, we are going to discuss the most important thing related to this chapter. So let's start discussing this chapter. The very first thing is the Negotiable Instrument Act. So the Negotiable Instrument Act of 1881, they deals with the three type of or the three kind of negotiable instrument. And the three kinds are promissory note, bill of exchange, and checks. Now, promissory note, bill of exchange, and checks. Why these are called as negotiable instrument? These are called as negotiable instrument because these can be transferred to any other individual to make them the holder of that particular instrument. So the when check or promissory notes or these checks or promissory note or bill of exchange, these are concerned, these can be transferred from one individual to another individual to make the another individual the holder of the check or instrument, and that's why these are known as negotiable instrument, and all these three are governed by the Negotiable Instrument Act 1881. So let's start discussing the very first thing, and the first is the checks. Now what is check? If we talk about the check, check is a written instrument. Check is the written instrument, or you can say check is the written instruction that is made by the maker of the check to the person to whom the payment direction is made that you have to make or you have to debit my account with a particular sum of money which is mentioned in that check and pay this amount to the holder of that check. Now, in the check, if we talk about the check, there are two person and the person was drawer and drawee. These are two parties in the check. Now, check is the written instruction given in writing by the account holder. So, account holder is actually the drawer. So, drawer is actually the maker of the check. So, the maker of the check, the drawer, or you can say the account holder of the check, writes the check in which there is an order that is given to the drawee. The drawee is one whom the direction is made to pay. So the account holder giving an instruction to his bank for making a particular payment from his or her account to the holder of that check. That is known as the check, right? So there are two parties that involved in the check. There are drawer and there are drawee. Drawer means the one who are having the account, okay, and who is instructing or who is making that check, whereas drawee is the one whom the instruction is paid. Now you know that check is present in the electronic form also, means in the check truncation system. If we talk about the CTS system has been introduced by RBI to eliminate physical movement of the check in the clearing process. So when there is an scanned image of the check which is actually flowed throughout clearing process of the check instead of the physical movement of the check. The process is known as the check truncation system. CTS system has been introduced to eliminate the risk of losing or lost check in the complete clearing process, as well as it actually reduce the time taken for the clearing of the check, right? So there is a check truncation system in the check. Next, if we talk about the promissory note. Now, what is the promissory note? Promissory note is a written instrument. Again, it is not a bank note or not a currency note. Other than a bank note or other than a currency note, promissory note is a written instrument, is a unconditional undertaking that is given by the maker or the payer of the promissory note that he or she will be responsible to pay a certain sum of money to the payee after a particular time period. This is known as the promissory note. Now, in promissory note, there are parties, the payer and the payee. The payer, the one who is promising to pay, the one who has to make the payment, and there is pay, the one person who has to receive the payment, who is entitled to receive the payment. For example, I am promising you that I will pay you rupees 1 lakh after 7 days, right? Now, for legalizing this situation, I am making this promise in written. I'm writing that I'm responsible to pay B rupees 1 lakh after 7 days. Okay, so this is what this is a promissory note. Now, in this situation, B is entitled to receive the payment, so B is the payee, and I am entitled to make the payment, so I am the payer. Clear? So this is known as the promissory. Next is known as the bill of exchange. Now, what is a bill of exchange? Bill of exchange again is an unconditional order signed by the maker, director, a person to pay certain sum of money on the order to the bearer of the instrument. Now, bill of exchange involves three parties, drawer, and drawer can be the seller or the creditor. There is a drawee, the one person who is directed to pay, and there is a payee who is entitled to receive the payment. Now, bill of exchange can have either two parties or three parties. What is a bill of exchange? I am explaining it with a simple example. Okay, for example, A has sell some goods to B. A has sell some goods to B. Now, instead of immediate payment, B just requested some time period from A. Now, A just given a certain time period and says that, okay, you have to make payment of this trade after 30 days. For legalizing this, A draws a bill of exchange. Who draws a bill of exchange? Seller. Seller draws a bill of exchange on B. Direct B that you have to make payment to me after 30 days. Okay. Now, here, just see clearly. So, A is the seller, and seller is also known as the drawer or the maker of bill of exchange. Now, he hasn't to pay the money. The bill of exchange is actually made by the creditor or the seller, direct the debtor or the buyer that you have to pay me a certain sum of money after this time period. Now, B here is called as the drawee, the one person to whom the instruction is made that you have to pay me after this time period. Now, in this situation, because A is saying that you have to pay A, means me, the certain sum of money after particular time period. So here the drawer, maker and the payee are same. Payee is one person who is entitled to receive the payment. So the drawer, the drawee and the payee. So in this situation, the drawer and the payee, they can be the same person. Okay. But for example, if the situation is like this, where A has sold some goods to B and granted a time period that, okay, you have to make payment after 30 days to C. Okay. Now here, because A has sold some goods to B, now A draws a bill of exchange on B, directing B that you have to make payment to C after 30 days. Okay. Now here, because A is making the bill of exchange and A is the seller and seller is also the drawer, the one who is making the bill of exchange, right? B is direct to pay. So B is the drawee. Okay. And here C is the pay. Pay means the one person who is entitled to receive the payment. So here always remember, drawer and pay, they can be same person and they can be two different person also. Okay. So there are either two or there are either three parties that involved in the bill of exchange. Now there is difference between bill of exchange and the promissory note. The very basic difference is, see, the one who is making promissory note is also the payer that you are responsible to pay, right? The one who is making the promissory note is actually promising to pay the other party the sum of money. So the one who is making the promissory note is also the payer of the promissory note. Whereas in bill of exchange, the one who is making the bill of exchange is not the payer. The bill of exchange is made by the creditor, which actually instruct the debtor or the buyer that you have to pay a certain sum of money to the other person, right? Now, what are the difference between the bill of exchange and promissory note? First, in promissory note, there are only two parties involved, and the two parties are the what maker means the payer or the pay, the one who is entitled to receive the payment. Okay. Whereas in bill of exchange, there are three parties: the drawer, seller, the drawee, buyer, and the payee, the one who is entitled to receive the payment. Maker and pay in the promissory note, they cannot be the same person, but here the drawer and pay can be the one person. Promissory and order. Okay, so it is promissory note, it is a promise to pay, whereas it is an order for the payment. In the promissory note, acceptance is not required, whereas in the bill of exchange, acceptance is required. The liability in the promissory note, where the liability of the maker is primary, you have to make the payment. Here, the liability of the drawer is actually secondary. Why? Because the primary liability is of drawee. Drawee has to make the payment to the pay. If drawee defaults, then the liability of the drawer arises. And that's why the drawer's liability is actually secondary in this case. To discuss about the responsibility of paying bank. This is Unit 13, PPB Module A. So let's start discussing. The very first thing is the Negotiable Instrument Act. So you all know the Negotiable Instrument Act deals majorly with the three kinds of negotiable instrument: check, promissory note, as well as the bill of exchange, right? So these are the major three negotiable instrument which are actually mentioned in the Negotiable Instrument Act, right? So the very first thing, the drawing, there is definition which says that the drawing of a check means the bank, the one who is directed to pay. The drawing of a bank should have a sufficient fund of the drawer in his or her hand, properly available for payment of such check when duly required to do so. So there are different conditions. First of all, when the drawer is making the check, it is necessary that the drawee should have the sufficient balance of the drawer in his or her account, so that he or that the bank can make payment of that check when it is required to do so. Required to do so means when the check is properly drawn and signed by the drawer. And if all things are available, it means that the drawee have the sufficient balance. Sufficient balance properly available. It means that it is not present in any investment or FD form. It is properly available for payment. Okay. And third, the drawer has actually signed and make the check clearly without any negligence. Now, it is the duty of the drawee to clear and to make payment of that check. And if after all this condition, means the drawee has the sufficient balance also, the drawee has properly availability of that also, and the drawer has signed and make the check clearly. Even if, even with all this satisfying condition, even if the drawee has wrongfully dishonored the check, the drawee has wrongfully dishonored this check. Now, in this condition, the drawee is responsible towards compensation, towards the compensation of all the loss that happens to the drawer. Now, here, always remember, when the bank wrongfully dishonored the check, the bank is liable towards the drawer in normal circumstances. Some circumstances, they actually liable towards the holder of the check also. And what are these circumstances? The first says that when the bank is, sorry, when the bank is actually wound up. Okay, when the bank is wound up, okay, now the holder of the check can claim himself or herself as the creditor, right? And then ask for the compensation from the drawee. And the second was if the check is paid disregarded of the crossing. So if this is a crossing account pay check, means you have to submit it on a particular, irrespective of that, bank has submitted it to another account. Now, in this condition, bank is responsible for compensating all the losses which the holder can have. So, in the normal circumstances, if we talk about the normal circumstances, yes, normal circumstances, the bank, the drawee is actually responsible towards the drawer. But only in these two circumstances, the drawer is actually responsible towards, the drawee is actually responsible towards the holder of the check. Clear? Now, next thing, if we talk about the sections. So first, section 89 of the Negotiable Instrument Act says that it actually gives the protection to the paying bank, which in which check has been materially altered, but it is not appeared to be materially altered. For example, there is a check and in which there is a name which is Afreen written, right? But someone has just cut this name and write Rashmi. Now, this is the obvious alteration. Okay, this is the obvious alteration. But for example, there is a check and in which 500 rupees is mentioned. Okay, now one more zero is added. Okay, and now the check is altered to 5,000. Now this alteration is so perfect that it is nearly impossible for the trained eyes to detect this alteration. Originally the check was 500, but it was materially altered as 5,000. Now this is the alteration which doesn't appear to be altered, and now if the paying bank has paid this check as rupees 5,000, the paying bank is protected from any type of loss and compensation. Why? Because this check has been materially altered in such a perfect manner that it is impossible for a trained eyes to detect that alteration. Clear? Second, section 10 defines payment in due course definition. Now, what is payment in due course? Payment in due course, it means that as a banker, as a drawer, you have to make payment of a check with the apparent tenor. Apparent tenor means you don't have to use your own brain in make payment of the check. No, you just do whatever is written in that check, whether it is account pay check or not, whether it is a crossed or not, whatever amount is mentioned, to whom it is concerned, everything. You have to make payment with the apparent tenor. Apparent tenor, next, you have to make payment as a banker in good faith without any negligence. Now, if you have make payment under the payment in due course system, now you have been protected if there is any loss. As a paying bank, you are protected if there is any loss that is incurred by the individual in this case. Third, section 31. Now, section 31 obliges the Troy Bank should have a sufficient balance of the drawer in its hand, which is properly available for payment. So, section 31 says that the drawer must have a sufficient balance of drawer which is properly available. It means that it shouldn't be in the form of any investment or FD that is not available for payment. So it should be available for payment. So these are the some important section of Negotiable Instrument Act, section 89, section 10, and section 31. Next, if we talk about if there is a payment which is made by a bank under a mistake, then what's happened? Now, this is all the case. I'm just giving you a short idea of the case. There was a bank, right? And the bank has made payment. Okay, the collecting bank has present this check to a paying bank, and paying bank has made payment to the holder of the check, right? But after the payment, okay, it came to be noticed that the signature as well as the amount in the check was forged. Now, in this case, paying bank has actually made a case against the presenting bank as well as the holder of the check or the pay, that you have to return the payment to me because the check was made under mistake. Payment was made under mistake because the signature has been forged and the amount has been forged. Now, the very first thing. First, let's discuss about the collecting bank. The collecting bank says that I am not responsible for any type of compensation. Why? Because the collecting bank says that I have followed all the procedure. I have made the payment with the apparent tenure. I have made the payment in foot. I have presented this check in good faith without any negligence. I have cleared all the thing. I have checked all the thing. There was no, and the forgery was so perfect that it was impossible for the trained eyes to detect that forgery, and that's why you also didn't have detect that forgery. So I'm not responsible for any type of compensation. Now, the one who received the payment says that, why I am responsible for the payment? See, this check has been presented to me by the representative of that company, and after he presented that check to me, I have given this check to the collecting bank, and the collecting bank enters this check to the clearing process. And after collecting bank confirms me that the check is in the clearing process, I have delivered good to that firm or industry. So I have parted away from my goods because the collecting bank has confirmed me that the check is all right. So I'm not responsible for any type of compensation. And here, in this case, paying bank has actually lost the case. The High Court dismissed the case of the paying bank that you will not get compensation or refund of the amount either from the collecting bank or from the pay, because they both acted in good faith without any negligence, and now you have to absorb all your loss by your own. Okay, so this was the case when the payment was done under mistake, right? So this was the chapter, and I haven't discussed the complete chapter. See, why? Because the complete chapter will be discussed in the foundation batch, which we have started recently. From today, I'm going to tell you about the details, okay? But first, just tell me the answer of this question. The law relating to payment of check and production of a bank is considered under or in which act? Indian Contract Act, Reserve Bank of India Act, Negotiable Instrument Act, or Banking Regulation Act? Everyone, please answer this question. The law relating to the protection of the paying bank is concerned under which act? Very easy. So if we are talking about this, yes, it is concerned under the Negotiable Instrument Act. The law relating to the payment of check and protection of to a bank, that is concerned in the Negotiable Instrument Act. Focus about Unit 40, that is responsibility of collecting bank. This is a very short unit, right? So we are going to discuss about this unit. Everyone who is watching this session, I request all of you to just please like and share the video to the maximum you can. Please, everyone, right? So, in the last session, in the last YT session, we have discussed about the responsibility of paying banks. What are the responsibility of a paying bank, right? In this session, we are going to discuss what are the responsibilities of collecting bank. This is unit 14. Let's start discussing. So first of all, there are conditions for the protection. Which act? It is actually under the Negotiable Instrument Act. So Negotiable Instrument Act Section 131 gives protection to the collecting bank if they are fulfilling or satisfying these conditions. And the conditions are, first of all, the collecting banker should act in good faith without any negligence. They should receive payment for a customer. The check is crossed generally or specifically, that should be verified. If they should verify the prime face genuineness of the check. While collecting the check, they must ensure that everything which appears on that check is correct. There is nothing wrong in that, and the check is free from any type of fraud, forgery, or tampering. So, if for example there is a check and my name is Afreen, which is written on that check, and that check is crossed, and then another name is written, that the collecting bank is not allowed to collect that check, right? So, collecting bank is protected when they actually followed these conditions. Okay, so these conditions are, first of all, the collecting bank should act in a good faith without any negligence. Okay, they should collect payment for the customer. They should check the prime face of the check. They should check that the check is free from any type of tampering, forgery, or fraud. They should check that the check is crossed, either crossed generally or specifically, right? Now, next, how can anyone ensure that they act without any negligence? So this is also the thing. Section 131 defines some condition that if you have followed these conditions as a collecting bank, if you have followed these conditions, it means that you have actually collected accept the check without any negligence and in good faith, and you are protected under section 131 of Negotiable Instrument Act. Now, what are these conditions? First of all, you have the duty to open account with documentary proof and references. So whatever account you are opening, first you should have a documentary proof as well as a reference for that opening of account. Second, you should done or confirm whether the referee is genuine or not. Whoever is referring the new customer KYC is compulsory, as well as the reference KYC is also compulsory. As a bank, as a bank, you should check that this is actually that the reference who is referring that customer is genuine or not genuine. Okay, you have to follow all the KYC, okay, and all the norms and rules and regulation which are presented in the Prevention of Money Laundering Act, right? Next, if we are talking about, you have the duty to ensure whether it is cross generally or specifically. Next, you have the duty to ensure that there is no apparent defect. Apparent means there is no visual defect on that check. You should take into account the customer's account. So if you are following all these conditions, you have done the KYC, you have checked the background, you have documentary process, etc. If you have followed all these conditions, it means that you have acted in good faith and without any negligence, right? And if you have acted in good faith without any negligence, you have checked the forgery, fraud, you have checked the prime face of the check, right? And everything is clear. And even if after following all these conditions, there is any fraud which occurs, now as a collecting bank, you are free from any type of compensation. You are free from any type of compensation. You don't have to compensate to anyone in this case. So this is according to section 131 of Negotiable Instrument Act. Okay, so this is it. This is a very short and cute chapter of the complete PPB. The shortest chapter of the complete PPB is this, the responsibility of the collecting. Right now, we are going to discuss some questions. First, in absence of proper KYC document, the collecting banker can be held liable for the collection of fraudulent check on the ground of negligence, convenience, crime, or arrogance. Everyone, please answer this question. Very easy. Everyone, just please like and share the video to the maximum you can. Everyone, it's a request that please just like and share the video to the maximum you can. Okay. In the absence of proper KYC, the collecting banker can be held liable for the collection of fraudulent check on the ground of what? So it is on the ground of negligence. So A is the correct answer. Very easy. Next, the condition for collecting bank to claim protection has been laid down under which act? Indian Contract Act, Banking Regulation Act, Negotiable Instrument Act, or Banking Companies Rule? Please answer this question. Very easy. So yes, the condition for collecting bank to claim protection, it is under the Negotiable Instrument Act. So C is the correct answer, right? To discuss Unit 15 of PPB Module A, that is Ancillary Services. What is Ancillary Services? First of all, this word, what is ancillary? Ancillary means add-on. Okay, so you all know that the main objective of a bank is to accept deposit from the public for purpose of lending, loan, or investment. This is the main function of the bank: acceptance of deposit for the purpose of lending, right? But if we talk about the ancillary services means add-on services. Add-on services like bank is giving you the deposit locker, bank is giving you the remittance facilities, bank is giving you the benefit transfers, bank is giving you insurance, bank is giving you the stock broker facilities. There are different add-on services. There are different ancillary services which the bank is or are offering you. So we are going to discuss about these ancillary services in this topic of PPB Module A Ancillary Services Unit 15. So before starting, everyone just please like and share the video to the maximum you can. And if you haven't subscribed this channel yet, guys, it is a request that please subscribe this channel and press the bell notification icon. Okay. Everyone, just please like and share the video to the maximum you can. So now let us discuss about what? Let us discuss about the remittance. The first ancillary service which the bank is offering you is the remittance. Remittance is what? Transfer of fund from one branch of bank to another branch of bank. So if you are transferring money from any one branch of bank to another branch of bank or a different branch, then it is known as the remittance services. Now there are different type of technologies that has been introduced in remittance services, like there is demand draft, mail, there is RTGS, there is NEFT, there is telegraphic transfer. So there are different type of transfers that has been introduced, different type of remittance services that has been introduced in the recent time or changing time. Okay. Now, let us discuss about the bank draft and bank draft and banker's check. So first of all, what is bank draft? Bank draft is a negotiable instrument and order drawn by one branch of a bank instructing another branch of the bank to pay a certain sum of money to the order of a certain person. So if you are talking about the bank draft. Bank draft is what? Bank draft is actually a negotiable instrument. Negotiable instrument is what? Negotiable instrument which can be transferred to another person. So bank draft is a negotiable instrument which allow the transfer of money from one branch of a bank to another branch of the bank, right? So it is the one branch of the bank instructing another branch of the bank that you have to pay this particular sum of money to the holder of this bank draft. This is known as the bank draft. Now, what is banker's check? Banker's check is actually issued for making local payments. Banker's check are actually issued for what? For making the local payments, right? Now, if we just a second. Okay, so if we talk about the banker's checks are generally used for what? So banker's check are generally used for these following transactions. First of all, it is used at the request of the client. Okay, it can be issued, it can be used at the request of the client. Second, the payment balance amount it's sent to the deceased account or the legal heir. So if bank want to transfer the amount to the deceased account of the deceased account to their legal heir, then this banker's check is used. Payment to the various contractor, service contractor, various purchases made by the bank. There should be the payment of statutory dues like electricity bills, and last, all the other local payments to be made by check. So these are the conditions for issuing the banker's check. So what is the bank draft and what is the banker's check? Clear? Okay, done? Okay, next. Next, just a second. Next, let's talk about the demand draft and the banker's check. Demand draft and banker's check, if we're talking about this, the issue and payment of banker's check and demand draft in cash across the counter is subject to income tax provision. Okay, so demand draft and banker's check, if the value is 50,000 and above, this shouldn't be made in the cash and this should be made in the banking channel. So the first point is saying that if you have any banker's check and if you have any demand draft and the value is 50,000 and above, and the value is what? 50,000 and above. So this need to be paid in what? Through a banking channel. This cannot be paid in cash. Okay. Second, if we talk about the payment of demand drafts and banker's check, now the limit has been reduced to 20,000. So now it is a provision that if you have any banker's check, and if you have any demand draft, and if the value is over and above 20,000, now this shouldn't, the payment of this shouldn't be made in cash. Okay, so this can be made either through a banking channel, okay, or through the remittance. It cannot be made in cash. Okay, next, if we talk about the time limit for presenting the banker's check and demand draft, so these are all valid for a period of 3 months. Okay, so from the date of issue till the period of 3 months. Okay, so if you are presenting the draft within the time period of 3 months, then it is all to paid, right? But if this 3 months time period is expired, then you have to revalidate it, and the revalidation means a reissue can be done only once within 1 year from the date of issue. And if the 1 year is passed, then the whole bank draft is cancelled. So very important thing is, first, the 3 months time period. So the bank draft should be presented to the bank for the payment within 3 months. 3 month time period exceeds, right? So now you have to revalidate, reissued it. Now the reissue can be done only once, and it should be done within 1 year of the date of issue. If 1 year also exceed, then it is cancelled. Now you have to take a fresh bank draft in this condition. Clear? So this is very important. Next, now let us discuss about the NEFT and RTGS. So these are the remittance facility. So the remittance can be through banker's check. The remittance can be through bank draft. The remittance can be through NEFT and RTGS. The remittance can be through NEFT, and it can be through RTGS also. Now, NEFT, National Electronic Fund Transfer, and there is RTGS, Real Time Gross Settlement. Okay. Now, first of all, let's start with the minimum amount that need to be transferred. So, in NEFT, the minimum amount that need to be transferred is rupees 1. In RTGS, the minimum amount that need to be transferred is rupees 2 lakh, right? So maximum amount in NEFT, there is no limit. In RTGS, there is no limit. Type of settlement. Here in NEFT, the amount is settled in batches. In NEFT, the amount is settled in batches. In RTGS, the amount is settled on one-on-one basis. If we talk about the settlement type, NEFT, it is settled in 2 hours. Here it is immediate. Settlement is done immediate. If we talk about NEFT, the transfer time is 24/7, all 365 days. It is 24/7 all the 365 days, whereas RTGS, it actually varies from bank to bank. If we talk about the mode of transfer, it can be both online and offline. It can be both online and offline. Additional charges in NEFT, there is no additional charges, whereas in RTGS, yes, rupees 30 is the additional charge if you are transacting between 2 lakh to 5 lakh. But if you are transacting over and above 5 lakh, then rupees 55 is charged. Additional charges is there. Okay. So NEFT, RTGS, bank draft, and banker's checks, these are the type of the remittance facility which has been offered by the bank. Now, another type of remittance facility is the electronic benefit transfer. Now, what is electronic benefit transfer? Electronic benefit transfer is a product for financial inclusion through which the payment reaches the beneficiary's bank account. So, if the payment is to be sent in a bulk, and in once to various beneficiaries and to various multiple account. What bank is offering you, what the facility that the bank is offering you, it is known as the electronic benefit transfer. Now, electronic benefit transfer is a very good way of increasing financial inclusion. What is financial inclusion? Financial inclusion is connecting maximum people with the banking system of the economy. Clear? Now, this program was aimed to transfer of subsidies and cash benefit directly to the people who have Aadhaar seated bank account. It is accepted way of delivering what? Delivering benefits under development scheme. So if you are a beneficiary under any development schemes of the bank, like there are the pregnant women schemes, lactating mother schemes, there are schemes for children, there are schemes for infant, there are schemes for girls. Okay, so there are different development schemes that actually started by the government for the development of the country, right? So if you are a beneficiary under this scheme and you have to receive subsidies or cash benefit directly from the government, and if you have Aadhaar seated account, Aadhaar seated account means Aadhaar, your bank account is linked with the Aadhaar account. Okay, so then the program which is offered to you is the electronic benefit transfer, right? Now, electronic benefit transfer is actually one district many bank, one bank leader model. The main objective is to facilitate direct credit payments due in the beneficiary's account on time. These payments could be for wages or for other material or administrative expenses. So these are electronic benefit or electronic benefit transfer. Okay, next. Now, next is safe deposit locker. Now, this is another ancillary function, ancillary scheme which the bank is offering you. The very first thing is safe deposit locker. What is this? So, a bank has some deposits locker. Bank offer this safe deposit locker to the customer on a lease for the safety of their valuable item. So this is known as the giving of the safe deposit locker. Now, in this, what is the relationship that exists between the bank and the customer? The relationship is of lesser and lessee, because the bank is giving that area, that space on a lease to the customer, right? Because bank is giving that area on a lease to the customer, so that is known as the lessor. Okay, that is known as, bank is known as lessor, the one who is giving, and the customer is receiving that area on a lease, so the customer is known as leasing. The customer is known as leasing, and leasing pays lease rental to the lessor on behalf of that space which they have taken on a lease. Okay, so the concept here is, this is one of the very important ancillary function, that the bank is giving safe deposit locker on a lease to the customer, okay, for the safety of their valuable item. And the relationship here exists between the bank and customer is of lessor and leasing. The one who is giving is the lessor. The bank is giving here, so the bank is lessor, and the one who is receiving is the leasing. And they here you will pay the locker rent. As a customer, you have to pay the locker rent or the lease rental for that safe deposit locker to the bank. Clear? Now, if we talk about hiring out of a locker, so what are the steps for hiring out of a locker? The first step is customer due diligence. The first step is what? Customer due diligence, the overall profile checking of a customer. Second, allotment of lockers, then you will allotted the locker. Third, model locker agreement, then you and your bank will enter into an agreement for the usage of that locker. Fourth, you have to pay the locker rent. Okay, and the fifth is term deposit. Sometimes the term deposit can be taken as a security for this locker. Clear? Okay, done. Now, next, if we talk about the some of the practice question related to this topic. The very first thing, a demand draft is issued by the bank to be valid for 12 months, 6 months, 3 months, or none of the above. Everyone, everyone, it's a kind request that please like and share the video to the maximum you can. Everyone, please just like and share the video to the maximum you can. Everyone, guys, just please like and share the video to the maximum you can. So it is a very easy question. A demand draft is issued by the bank which is valid for how many months? 12 months, 6 months, 3 months, or none of the above. So the correct answer is 12, 6, 3, or none of the above. So the correct answer is what? So a demand draft is issued for how many months? So a demand draft is issued for 3 months. It is revalidated only once within 1 year, and after 1 year, it is now cancelled. Okay, so that is the concept of demand draft. Okay, next, one of the following statement is not true with respect to RTGS. One of the following is not true with respect to RTGS, everyone. One of the following statement is not true with respect to RTGS. There are 4 statements. You have to answer it. Everyone, please answer this question. Everyone, guys, it's a very easy question. Please answer this question. One of the following statement is not true with respect to RTGS. One of the following statement is not true with respect to RTGS. Everyone, please answer this question. So if we talk about one of the following statement is not true with respect to RTGS. So which of the following statement is not true with respect to RTGS? Funds are transferable from branch of one bank to branch of another bank. Only corporate and government departments can avail this facility. RTGS system is maintained and operated by RBI. Each participant of RTGS is required to open a dedicated settlement account for putting through it in the RTGS transaction. So obviously B is not the correct statement, because it is not only available to the corporate and government, it is available to each and every citizen who are living in India, right? So RTGS, B is not true. Implementation of EBT scheme is meant for which type of accounts? EBT, electronic benefit transfer. Implementation of electronic benefit transfer is actually for which type of customer? Electronic benefit transfer is actually for which type of customer? Pensioners, high net worth individual, low value accounts, or disabled persons. So the correct answer for this question is what, everyone? So the correct answer for this question is was implementation of electronic benefit transfer scheme is actually for what? It is actually for low value accounts. So if you are a beneficiary under any scheme of the government, you have low value account, and for these there is EBT, electronic benefit. To discuss about unit 16 PPB module A, that is financial inclusion and financial literacy. So we are going to talk about these two terms, financial inclusion and financial literacy, in today's session. So just please like and share the video. Everyone who is watching this session, it's a request that please just like and share the video to the maximum you can. Everyone, guys. Okay, hi guys, hello. Okay, so let's start discussing with the very basic thing, that is financial inclusion. What is financial inclusion? If we are going to talk about what is financial inclusion means connect maximum people with the banking system of economy. So if we are going to give maximum people the advantage of the banking services, okay, so what the banking is offering you, like deposit account, current account, saving account, term deposit account, everything, right? So what is going, or what the banking is giving to you, or to connect you with banking system, when the activities and when the initiatives are taken, connect maximum people with the banking system of the economy, then it is known as what? Then it is known as financial inclusion, right? Like for example, we have started, or bank has started, the zero balance account concept. What is this zero balance account concept? Zero balance account concept is a concept in which you don't have to maintain any balance while opening the account. So this is a very good way of connecting various people to the banking system of economy. It attracts individual at the college level also. It attracts the individual who are initiating the employment. So these are the initiatives which are taken for connecting maximum people with the banking system of economy. So this is known as what? This is known as financial inclusion, right? Now, if we talk about business correspondent and business facilitator, business correspondent and business facilitator, these are the two uh, extended arms of the banking system. You can say that these are what? These are the extended arms of the banking system. How they act as an extended arm of the banking system? So they actually provide banking services on the behalf of the banking, right? So if we are talking about the bank at an individual level, it is not possible for bank that they can start. It is not possible for the bank that they can start the branches in each and every remote area. It is not feasible, and it is, in fact, it's not possible, right? So bank use the concept of this business correspondent and business facilitator. So these are those individual or entities or group who work on the behalf of the bank. They provide banking services on the behalf of the bank to the unreached people, and that's why they are contributing in the financial inclusion of the country. So business facilitator, who act as a business facilitator and who acts as the business correspondent. So first of all, if we talk about the business, what BFs, the business facilitator model, bank can use these, like bank can use self-help group, non-government organization, community-based organization, insurance agent, panchayats, village knowledge center, agri clinic, okay, Krishi Vigyan Kendra, Khadi and Village Industries Commission. So these are those entities and groups which are acting as a business facilitator for the banking system. You can say they are the extended arms for the banking system. Clear? Now, these are individuals. These are the individual who are acting as a business correspondents, right? Now, business correspondent, if we talk about the individual, these are the retired bank employees, retired teacher, retired government employees, fair price shop, the individual owners of kiranas, is agent of a small saving schemes of government, insurance companies, individual who owns petrol pumps. So these are those individual who act as a business, act as a business correspondent for the banking system, and they provide banking services on the behalf of the bank, and they provide banking services to the unreached people, right? Now next, if we talk about the small, ultra small branches. Now what are the concept of these ultra small branches? RBI, Reserve Bank of India, has given actually the permission to open ultra small branches. For whom? They actually opens the ultra small branches for the business correspondent, or a place where BCs can work, or BCs can provide banking services on the behalf of. So these are very simple brick and mortar infrastructures. These are the simple wall and mortar structure, nothing show or nothing, any branding, nothing. These are actually providing a space for business correspondent to work. Now, every business correspondent is under the site of base branch. So there is a base branch and there is a business correspondent location. Between this, the ultra small branches have been set up, which provide a working space, for whom? These provide a working space for the business correspondent, right? Because see, most of the business correspondent, they work on a field, right? They are working on a field. So they are working on a field, right? Now they want a area to sit. Then they want a office space also. So RBI has given permission to different banks that they can open ultra small branches to provide a working place for the business correspondent, right? Now, readdressal of the grievances that are the services rendered by the BCs and BF. So, because these BCs and BF, they are rendering services on the behalf of the bank. Okay, so obviously customer has some dissatisfaction, customer has some grievances, customer has some complaints on the services which are given by BCs and BFs, right? So to handle these complaints, the bank should have a proper grievance readdressal committee. So bank should have a grievance readdressal machinery to solve and for addressing problems which are faced by the individual on the services which are rendered by BCs and BF. The bank should display the time period in which they can respond to the complaint, and if that customer is not getting a satisfactory response or satisfactory solution on the grievance of the complaint, then they have all the right to complain about that thing to the banking ombudsman office also. And banking ombudsman, you all know these are appointed by Reserve Bank of India. Clear? So these are ultra small branches, and the grievances or readdressal of the grievances which are rendered by the BCs and BF. Okay. Now, next, payment bank. Now, if we are talking about the payment bank, now what are payment bank? For payment banks, the objective of payment bank is actually to provide remittance services to the unorganized sector. So there are unorganized sector, migrant workers, labor, low income household. They also want to remit money from one bank account to another. Yes or no? Obviously, if they are living in a society and now the technology has been introduced so much, so they are also in a need transfer money from one bank account to another bank account. So for transferring of the money from one bank account to another bank account, for especially providing this remittance facility to low income household, unorganized sector, labor workforce, migrant workforce, the payment banks are started. And payment bank also offer the small saving account facility to the individual. Now, small saving account, why it is said as the small saving account? So it is said as small saving account because first of all, except demand deposit, because here in this account particularly, the deposit is accepted up to rupees or up to maximum of rupees 2 lakh per customer. They can issue ATM debit cards, prepaid instrument, they can have the internet banking services, payment and remittance services, utility bills, mutual funds, insurance, etc. Right? And there is a necessary condition for the payment bank. So if you are operating the payment bank, you should have at least 25% of their physical access point, which include business correspondent in the rural centers also. So these are payment banks. See, in inclusion, payment bank, and these, if we talk about the payment bank, and if we talk about these ultra small branches, these are the very good ways of increasing the financial inclusion in the economy. Clear? Now next, if we talk about the financial literacy. Now, if we talk about what? If we talk about the financial literacy. Now, what is financial literacy? So, financial literacy is actually providing knowledge and actually providing the understanding that how the customer can use the financial product and services that is offered or that are offered by the banking system. So, these are known as the financial literacy. Now, this is very important. See, financial literacy and financial inclusion, these are the twin pillar. When to the financial literacy stimulates the demand side of the consumer. How it can stimulate the demand side? Because while giving the financial literacy, we are making aware to the we are making aware the people what are the product and services the bank is offering you, right? So if people are aware of what are the services they are being offered by the bank, they will demand, right? If they have knowledge, they will demand, obviously. And that's why financial literacy actually helps to stimulate the demand side of the consumer. And then comes the role of financial inclusion, which actually provides supply for demands. If you have a knowledge of mutual fund, you demand for a mutual fund, then there is a bank which is giving you services for that mutual fund. So these are the twin pillar: financial literacy and financial inclusion. Clear? Now next. If we talk about the initiatives, yes, there are different initiatives that has been taken by Reserve Bank of India. There has been different initiative that has been introduced, that has been taken by Reserve Bank of India. Okay, and what are these initiatives? The very first initiative is National Center for Financial Inclusion. So there is a National Center for Financial Inclusion that has been set up in 2013 with the support of all the financial regulators like RBI, SEBI, IRDI. And the objective of this is to provide financial literacy and inclusion in India in a collaborative manner. So this was the first initiative that has been started by Reserve Bank of India. Second, Centers for Financial Literacy. Again, the main objective behind setting up of Central for Financial Literacy is to provide financial literacy support to the individual, right? Now, if we talk about RBI has launched this in 2017, the Center for Financial Literacy, right? And these are set up in a block or phased manner in the complete country. Now, next initiative is the Rural Self-Employment Training Institute. Rural Self-Employment Training Institute. Now, what are these? First of all, if we talk about the Rural Self-Employment Training Institute, these are set up, first of all, under the Ministry of Rural Development, MORD. These are set up under the Ministry of Rural Development, and they will provide you the dedicated infrastructure in each district for imparting training and skill upgradation of the rural youth and aimed at providing them the entrepreneurship skill. So these has been started under the model of Self-Employment Training Institute in 1960. So these initiative that has been taken by Reserve Bank of India for financial inclusion and financial literacy, for spreading financial literacy and financial inclusion among all the world, among all the countries part, among all India, right? Now, let us discuss about some of the practice questions. Whoever is watching this video, guys, it's a request that please like and share the video. Whoever is watching this video, guys, it's a request that please like and share the video to the maximum you can. Everyone, just please like and share the video. Okay. Now, let's start discussing the practice question. The very first is bank cannot use the service of Dash as a business facilitator or a business correspondent. Bank cannot use the service of Dash as the business correspondent or the business facilitator. Everyone, please answer this question. So, if we talk about bank cannot use the service of Dash as a business facilitator or business correspondent. So, if we talk about this, yes, bank cannot use the service of village sarpanch as a business facilitator or business to discuss PPB Module A, that is Customer Service Guideline. This is Unit 17, Customer Service Guideline, PPB Module A. So let's start discussing this. First of all, the Customer Service Guideline. So the RBI has emphasized that the matter which are related to the customer service should have or should be dealt by a deliberate board. So there should be a deliberate board which are dealing with all the problems which are faced by the customer. For enhancing the customer experience, it is very compulsory to solve the grievances of the customer as well, right? And so RBI has emphasized that for solving the grievances of the customer, there should be a deliberated and a dedicated board. The board needs to review what? Board needs to review service aspects in the bank. So detailed memorandum should be submitted to the board of director once in every 6 months. Now, if we talk about the prescription, what are the institutional setup for the customer service guidelines? So institutional setups are what? First of all, customer service committee of the board. Okay. Okay. So customer service committee of the board. Okay. Second, standing committee on customer service. Third is branch level customer service committees, and fourth is nodal department official for customer service. So these are the customer service guidelines. Everyone, just a second. Okay. So our prescribed institutional setup for bank includes what? So prescribed institutional setup for bank, first of all, there is a customer service committee on the board. Second, there should be standing committee on the customer service. There should be a branch level customer service committee. And fourth, there should be nodal department official for the customer service. Okay. So these are the prescribed institutional setup for banks. Next, board approved comprehensive policies. Now, what are the board approved policies on the customer service? So, there are four different policies which a bank need to start if they want to give a better experience to the customer, right? So RBI has stated each and every bank, and RBI has instructed each and every bank that they should start a board approved policies on the customer experiences. Like, first of all, there's a comprehensive deposit policy. So banks should have a transparent and comprehensive policies setting out the right of depositors in general and small depositors in public. So whenever a customer is coming in the bank and they are demanding for anything, when a customer is coming in the bank, they are having the current account or the saving account. So what should be the right of that depositor? How the depositor is dealt? What are the rights of that depositor? Rights of that, you can say, right of that particular deposit. This should be cleared under the comprehensive deposit policy, right? So comprehensive deposit policy, this has been issued by the Reserve Bank of India and instructed by RBI that each bank should have a comprehensive deposit policy, so that they can do what? They can just set, or they can just clear the right of each and every customer. Second, check collection policy. So if we are talking about the check collection policy, banks should have a comprehensive and transparent policy on the collection of the check. Banks should have a transparent and comprehensive policy on the collection of the check. Immediate credits for the local and outstation check should be there. Time frame for the collection of local and outstation check. Interest should be paid for the delayed collection. So check collection policy means what should be the time period for the collecting of the check, what should be the time period that involves in the clearing of that check. That should all be included in this check collection policy. That should all be included in this what? In this check collection policy. Third, customer compensation policy. Now, what is customer compensation policy? Bank should have a customer compensation policy, that if there is any unauthorized check, if there is any unauthorized check, the bank should have a customer compensation policy for that. Also, if there is an unauthorized transaction, if there is a delay in the collection of the check, the bank should provide compensation to their customer. So this should be a customer comprehensive or customer compensation policy. For the customer grievance readdressal policy. Now, customer grievance readdressal policy, this is a well documented customer grievance readdressal policy. So for solving the customer grievances. For solving the customer grievances, there should be a proper customer grievance readdressal policy also, right? So comprehensive deposit policy, check collection policy, customer compensation policy, and the customer grievance readdressal policy. These are the four comprehensive policies that RBI has recommended that each bank should have, right? Now, let's talk about the ATM operations. Okay, now I'm sitting and just teaching about the ATM operations. So free transaction, first of all, customers are eligible for free transactions at the ATM. So if you want to have a good customer experience, if you want to give your you can say whoever is in front of you, the customer you are dealing, if you want to give them a better customer experience, so they should provide you a free transaction at the ATM. So customer is eligible to have a free transaction, and that is actually 5 free transaction, which include financial and non-financial transaction every month from their own bank ATM. And the bank is also providing them the free ATM transaction on the other bank at the ATM, right? So, if we talk about the 3 transactions in the metro centers, so there are 3 transactions in the metro center and 5 transactions in the non-metro centers. So, free transactions at the ATM. Okay, transaction in the ATM, PIN validation for every successive transaction. So, there should be a PIN. Uh, there should be a PIN validation for every successive transaction. Third, logic of the ATM related complaints. So if we talk about the ATM related complaint, so if there is any customer who have any complaint regarding this ATM, so to file, there should be a complaint lodging related to ATMs, right? There should be a telephonic numbers of the health check contact person that should be displayed on that ATM. There should be a uniform template also that should be prescribed by RBI for lodging the complaints of that ATM. So ATM operation, if we talk about this ATM operation, free transaction, 5 free transaction from their own ATM. From others ATM, they are eligible for 3 free transaction in metro center, and in non-metro center, 5 free transaction. And there should be a PIN validation for each and every successive transaction. Okay, and if you want to lodge any complaint, ATM related complaint, then you have to do what? Then you have to just give the telephonic number of the help desk contact person, uniform template prescribed by RBI for that ATM related complaints. Clear? So these are the free ATM transaction which you need to provide in a bank. Next, if we talk about the next thing, securities issues and risk mitigation method. Now, what are the securities issues and the risk mitigating factor that a bank need to follow or anyone need to follow? First of all, online alert should be given for the usage of debit and credit card, obviously. So when you are using the debit card, when you are using the credit card, the online alert should be sent on your mobile phone. This is a very first and the topmost priority for having the security in the transactions. Next, card not present transaction. Now, what is this card not present transaction? CNP. Card not present transaction means there are some obvious details which are present on the front of the card, right? So there are card number, the expiry, the CVV, the name on the card, everything is present. The card not present means there should be one extra step for authorizing the transaction, and that should be by providing that information which are not present in that card. For example, an OTP should be sent to your registered mobile number. When you are swiping your card, there should be extra step for authentication of that transaction, and that should be by any of the information which is not present at that card. Like there is an OTP which is sent to your mobile number, right? So this OTP is actually what? This OTP is actually the card not present transaction, an extra step taken for security, right? Next, electronic payment transaction, it should be safely executed. Next, limited liability of the customer for unauthorized electronic banking transaction. So if there is any unauthorized electronic bank transaction, the customer is entitled to have a limited liability. In some cases, they are entitled to have a zero liability, and in some cases, they are entitled to have what? In some cases, they are entitled to have a full or limited liability. Now, which are the cases in which the customer is entitled to have a zero liability? Now, in which cases the customer is entitled to have a zero liability? First, if there is any contributory fraud, negligence, deficiency on the part of the bank. So, if there is any deficiency on the part of bank, negligence, fraud, anything, okay, even if the customer is not reporting that unauthorized transaction, the customer is entitled to have a zero liability. If there is any third party breach and there is no deficiency with the customer or the bank, then also the customer is entitled to have a zero liability. For example, there is any third payment gateway that I have used for transaction and the security of that third payment gateway has been compromised. Now, in this case, there is no fault of mine. Either the bank is not at fault, but there is a third party whose payment gateway is actually the security is compromised from that. Okay, so in this case, the customer is entitled to have a zero liability. And second, customer is entitled to have a zero liability if there is any fraud or negligence on the behalf of the bank, on the part of the bank, right? Second, if there is any loss that shall be borne by the bank, if there is any loss that shall be borne by the bank, in a case where the responsibility is not with the bank or the customer but elsewhere in the system, and when there is a delay in reporting like 4 to 7 working days, the liability of the customer is as defined as per the limit or the transaction value, whichever is lower. It means that now in some cases where there is no default of anyone, right? Now in this case, the customer is entitled to have a limited liability. Limited liability in the sense, like if the customer has reported that unauthorized transaction within 4 days, then the customer is entitled to have zero liability. If the customer is actually reporting that transaction and there is a delay in reporting of that transaction and that delay is like 4 to 7 days, okay, so customer is reporting between 4 to 7 days, now customer is entitled to have a limited liability, and the limited liability is explained in such a manner that the liability is set for each and every class of customer. Like if you are holding the BSPTA account, your maximum liability is 5,000. If other saving account, current cash and credit, overdraft, and you have a credit card which a limit of 5 lakh, then you have a maximum liability of 10,000. And if you have a credit card with a limit of above 5 lakh, then you have a limited liability of 25,000. It means that, for example, there is any unauthorized transaction and I have delayed in reporting that transaction, and the delay is like I have reported this between 4 to 7 days. And then unauthorized transaction is, for example, of rupees 10,000. Now, if I hold a PSPD account, it is the limited liability that lies on me. And for a PSPTA account holder, the maximum liability can be 5,000. The unauthorized transaction is of 10,000, but now I am only eligible to compensate or to give only rupees 5,000 in this case. Why? Because this is a limited liability of the customer. For example, the unauthorized transaction is of rupees 2,000 and the maximum liability is 5,000. So whichever is lower, 2,000 is lower. Now I have only entitled to compensate rupees 2,000. If I hold credit card of less than 2.5 lakh, the maximum liability is 10,000, and over and above 5 lakh, the maximum liability is 25,000, right? And this is when you are delayed in reporting. You are delay in reporting and you are reporting between 4 to 7 working days. If you are reporting before 4 days, then you are entitled to have a zero liability. And if you are reporting after 7 days, if you are reporting after 7 days, then the bank is free to decide your liability. It is also the limited liability in that case, but bank is free to decide your liability, right? So next, service at the counter. So there are different services as a banker you have to give at the counter. Now what are these services? First, service staff should arrive 15 minutes early. First of all, the staff should arrive 15 minutes early. Second, branches open at least 4 hours on weekdays and Saturdays. There should be varying banking hours, rural branches flexible. They should comply with all the local laws and the staff obligation. They should attend all the customer at closing time. There should be an extension of business hours also for non-cash transaction. There should be an evening counters. Evening counters means bank can have an evening counter at the premises of the existing branch in urban and metropolitan centers for providing facilities to the public beyond the normal hour of the business so as to bring improvement in the customer service. So these are the services which are provided at counter. So these are what? These are the services which are to be provided at the counter. Clear? Next. If we talk about the information to the services, though there are different information that need to be displayed to the customer also. Now, what are these information? First of all, the bank should have a notice board, and that notice board should be updated. That should be bilingual and marked changes. Okay. Second, the booklet and brochures, there should be bilingual in 10 fonts. Website display, there should be accessible for home pages. Other display like there should be touch screen and tag boards. The interest and service charges, it should be prescribed in a format. Information should be present in the public domains like policy guideline, complaints, accounts, loan branches. Timeline for the credit decision, it should be disclosed on the websites and notice board, and the service changes should be displayed in the local languages. So these are some of the information that need to be provided to the customer. So these are the customer service guidelines. Overall is what? The overall procedure of this is to enhance the customer services in whatever way you can. So bank are now competing on the customer services, right? Bank are now competing more and more and more on customer service, on enhancing the services. One bank is given preference in respect to another bank. How they are given preference? They are given preference because of the what? They are given preferences because of the customer service. If you as a customer is going to the bank and you are having a good experience at the bank, obviously you will opt for that bank. And this is how the competition is there in the banking environment. And so RBI has recommended different guidelines. RBI has recommended different procedures how you can improve the customer service at your branch or the bank. Clear? So this is the chapter. I have discussed the most important things related to this chapter. Now,
To discuss about the duties and right of the banker and customer right, this is Unit 18 PPB Module B. We are going to discuss about the most important things related to this chapter. So let's start discussing first of all what are the bankers' right. Now let's talk about the very first thing. What are the bankers' right? So bankers' right include the bankers' lien, right of set off, right of appropriation, and right to charge interest or commission. So if we talk about the banker's lien, so what is a bank's lien? Bank lien means a bank has the right to retain the possession of the goods until the debt of the debtor is fully paid. For example, I have received some gold loan, right? I have received some gold loan, okay, and I have given my gold as a collateral to the bank, right? So bank has the right to retain the possession of that gold until the debt of the debtor, until my debt is fully paid. That is known as banker's lien. Right. Next is right of set off. Now, what is right to set off? So, if I have two or more account in the same bank, right? And one shows the debit balance and one shows the credit balance. So bank can use or bank can exercise this right to set off. And how the bank can exercise this right to set off? By just setting off the my debit balance with the credit balance. For example, I have 500 rupees debit balance in one account and the other account shows a credit balance of 5,000, right? So my 5,000 rupees will be what? Will be debited, or my 5,000 rupees will be what? Will be set off with this with this for 100 rupees, right, or 500 rupees. So one account shows a balance of 4,500 after setting off, and one balance shows zero balance, right? So this is known as right to set off, means setting off my debit balance with credit balance. Third, right of appropriation of account. So if we talk about right of appropriation account, so if I have deposit some money in my account and I have some pending EMIs or pending loan in my account, and if I haven't stated the purpose, that for which purpose I'm depositing this balance to my account to the bank, if I haven't specified, then only bank has the right to appropriate or to settle my pending EMIs or loan with credit balance which I have deposit in that account. So this is actually the right to set off. Now, right to charge interest or commission. Now, what are right to charge interest and commission? So, bank is are giving different services to the customer, right? Bank are giving services to the customer. Now, for that services, bank can charge interest or some fees on the behalf of that, right? And that interest and commissions and charges should be as per what it should be as per the standards which are set by Reserve Bank of India. So right to charge interest or should clear. So there is a bank lien, there is a right to set off rent, there is a right of appropriation, and there is right to charge interest or commission. Clear? If we talk about the next thing, banker's right. So bank has also the right to terminate the bank customer relationship at any point. So bank has also the right to terminate the bank customer relationship at any point, whereas if we talk about the customer has also the right to terminate the bank customer relationship at any point of time. Now, if we talk about the bank's right, the first is the voluntary termination. So, voluntary termination says what? Voluntary termination means the customer has a right to close his or her deposit account because of change of residence or dissatisfaction with the service of the bank or for any other reason, and the bank is bound to comply with the request. So there is a voluntary termination thing. Voluntary termination means you are terminating it by your will. You are terminating it by your own will. This is actually the voluntary termination. So if the bank wants to terminate the bank customer relationship, bank can terminate the bank customer relationship at any point of time from their side. But if the bank is deciding to do so, bank has to give proper notice to the customer. Whereas if the customer wants to end the bank customer relationship from his or her side, they don't even have to give notice to the bank. If anyone want to exercise this right, the other party has to follow that order. Okay, so this is actually the voluntary termination. Clear now? If we talk about the termination by law, okay, so termination by law, if we talk about the termination by law, so the termination by law, the relationship of bank customer can also be terminated by the process of law. This can also be terminated by the process of law. Then how this can be terminated by the process of law? First, if there is a death of customer. If there is a death of customer means if the bank receive notice or information about the death of the customer, the very first thing the bank should do is to stop all the debit transaction in the account. They actually have to stop all the debit transaction in the account. However, the credit transaction can be permitted. Okay. Now, the balance of the account is given to the nominee if available or to the legal representative of that deceased. So, there is a death of the person. Now, if there is a death of the person, all the debit transaction in the account should be stopped. However, the credit transaction of the account can be permitted and the balance in the account is given to the nominee or the legal heir.
Second, bankruptcy of the customer or liquidity. So if there is a bankruptcy of the customer, or if there is a liquidity of the company, in such cases, the bank has the right to what? To just terminate the bank customer relationship. So bankruptcy of the customer or liquidation, bank has the right. On death of the customer, bank also have the right to terminate the bank customer relationship. Now, when they receive garnishee order. So if we talk about the garnishee order, when they receive the garnishee order, so as already discussed, after receiving the garnishee order from the court or attachment order from the income tax authority, the account can be closed as one of the option after taking all the required steps. So after taking every required step, means garnishee order is what? I've already explained you that garnishee order is issued by the court to the bank for freezing a certain amount in the debtor's account and directly crediting it to the creditor's account. So after taking all the necessary actions, after completing the garnishee order, the bank has this right that they can what? Terminate the bank customer relationship or close the account of that customer. Clear? Now, insanity of the customer on receiving the news of the lunatic person, on receiving the news of unsound mind. Okay, in the Indian Contract Act 1872, the bank customer relationship is contractual, and in this case, the bank has the right to terminate the bank customer relationship. So, insanity, voluntary, garnishee order, and if we talk about the bankruptcy or liquidation of the company, these are those circumstances in which the bank has the right to terminate the bank customer relationship. Clear? Everyone, just please, everyone, like and share the video to the maximum you can. Everyone who is watching this session, it's a request that please like and share the video. Please just like and share the video to the maximum you can. Everyone. Done? Okay, next. Now, let's talk about the next thing. That is Banking Code and Standard Board of India, BCSBI, a very important part of this topic. See, from this, we have seen a lot of question in the examination. The Banking Codes and Standard Board of India. Now, in November 2003, RBI has constituted a committee on procedure and performance audit of the public service under the chairmanship of SS Tarapur, right? And they have to address the issue relating to the availability of the banking services to the government. So there is SS Tarapur committee which actually formed BCSBI, Banking Code and Standard Board of India, in the functioning line of UK. So whatever the practices and the standard that was used in UK, based on that line, BCSBI has actually established a committee which is known as SS Tarapur has actually established a code which is known as Banking Codes and Standard Board of India. Now, BCSBI, this is registered as a separate society under the Societies Registration Act 1860s, and they are actually watchdog. They are considered as the watchdog of the banking industry. So, this actually is there for ensuring the rights of the consumer, right? So what they are promised by the bank, if they are getting that or not, whatever they have promised by the bank, they are getting it or they are not getting it. So for ensuring that, Banking Codes and Standard Board of India has been set up by SS Tarapur committee. But later, RBI has actually set up the Consumer Education and Protection Department, which is issued by Charter of Consumer Right, COCR. This is issued by who? Charter of Consumer Rights. Okay, and this is actually what? It is actually dissolve, or it actually dissolved the BCSBI. So currently, BCSBI is actually not valid. Okay, instead of this BCSBI, now the Charter of Consumer Right is acting as a watch
watchdog of what it is acting as a watchdog of Banking Boards and Standard Board of India. Okay. Now the two codes, these two codes are issued by BCSBI, set minimum standard of banking practices for the member bank to follow when they are dealing with individual customer and micro and small enterprises. So these are the two very important codes that has been given by BCSBI. Codes on bank commitments to the customer and code on bank's commitment to the micro and small enterprises. Clear? Okay, now this is the chapter. Let's start discussing some of the practice question. Everyone, let's start discussing some of the practice question. Everyone, just please like and share the video to the maximum you can. It's a request from my side that please like and share the video to the maximum you can. Everyone, guys. Done. Let's start with the practice question. Okay, the very first question of the class is the obligation of the bank to keep the affairs of their customers secret and confidential arises from Banking Regulation Act, a specific law for banking secrecy, contractual relationship, or none of the above. Everyone. The obligation of bank to keep affairs of their customer confidential arises from where? Everyone, please answer this question. It arises from where? Banking Regulation Act, specific law for banking secrecy, contractual relationship, or none of the above. So the correct answer is what? It is the contractual relationship. It is what? It is the contractual relationship. Next, if we talk about in which of the following situation is the bank authorized to share the information? In which of the following information bank is authorized to share the information? These are the four conditions. Now just read out this condition and answer this question, everyone. Just read out this condition and answer this question. Please answer this question, everyone. Just read out and answer this question. So the correct answer for this question is what, everyone? Yes, so the correct answer is yes. So if we talk about the correct answer, which of the following situations the bank authorized to share the information? So the balance in the saving account is blocked as per the attachment order. It is blocked as per the attachment order of the income tax officer under the advice of the consumer and the income tax department. So this is the correct answer. Discuss Unit 19 PPB Module B, that is grievance readdressal and RBI integrated ombudsman scheme. So this is Unit 19 Module B PPB. So let's start. I think this is Module A, not B. Sorry for the mistake. This is Module A, not B. Okay. So let's start discussing this chapter. Okay. So the very first thing is model policy on grievance readdressal. So you all know that a customer need to be addressed carefully in the bank or in any premises. If we talk about the grievance readdressal policies, if any customer is going through any grievances, if any customer is going through any complaints, a bank or an institution need to take care of this grievance readdressal as soon as possible, right? So there are grievance readdressal model policy which are based on different principles. Now, what are these principles? First of all, if we talk about the first thing, the customer will be treated fairly at all times. The very first thing is the very first principle which is to be noted is that a customer should be treated fairly at all times. Complaints should be raised by the customer and it will be dealt with courtesy at all times. So whatever the complaint the customer is actually telling in the bank, it should be dealt with courtesy and it should be dealt in time. Customers should be informed of the avenues to escalate their complaint and grievances within the organization, and their rights to alternative remedy is if not fully satisfied. Okay, it means that if the customer is not satisfied with the counter staff, or if the customer complaint is not handled carefully at the initial level, then
The customer need to know how to escalate this method if they are not fully satisfied. Okay, what are the procedure to escalate these method? Then the bank should treat all the complaints efficiently and fairly. Last, the customer will employees will work in a good faith and without any prejudice to the interest of the consumer, right? So this is the principles. These are some principles on which the grievance readdressal policy should be based on, right? Now, next, if we talk about internal machinery of how to handle customer complaint and grievances. So there are a lot of internal machineries, there are a lot of internal mechanism that how to deal with the customer complaint and grievances, right? In which there is a first thing, I'm just giving you a short overview, and that is the principal nodal officer. See, principal nodal officer is very important. So every bank is required, or every bank is required to maintain or appoint a principal nodal officer under the ombudsman scheme, and that should be not below the rank of general manager. So whatever the rank of general manager, the principal nodal officer should be equivalent to the rank of general manager. The name and address of the principal nodal officer, this should be forwarded to the chief general manager, customer education and the protection department and Reserve Bank of India. So these are the principal nodal officer. The bank should or the bank are required to appoint a principal nodal officer, and that should be equivalent to the post of the general manager. The name and address of the principal nodal officer, this may be forwarded to the chief general manager, customer education and protection department, and RBI. Contact details of the principal nodal officer need to be prominently displayed in the portal. So whatever the contact detail of this principal nodal officer, this should be displayed in the portal. Okay, and why it should be displayed on the portal? So that whoever is the customer who is aggrieved and not satisfied with the bank services can approach for the sense of satisfaction that she is attended at a senior level. Because see, this principal nodal officer, the post of principal nodal officer is equivalent to the post of the general manager. Clear? Everyone, guys, clear? So just please like and share the video. Whoever is watching this session, it's a request that you have to please like and share the video to the maximum you can. Okay, now next, if we talked about CCSO, very important things, right? This CCSO, again, this is a very important thing. So Chief Customer Service Officer. Okay, so with a view to boost the further quality of the customer services and ensure that there should be an undivided attention to the resolution of customer complaints in the bank, in May 2025, RBI has advised some few banks that they should appoint an internal ombudsman. They should appoint an internal ombudsman, which is known as Chief Customer Service Officer. So, first of all, the very important thing is Chief Customer Service Officer, CCSO. The CCSO is also known as the internal ombudsman, right? So the few banks were advised in 2015 that RBI has advised few banks in 2015 that you have to appoint a CCSO, Chief Customer Service Officer, which is like an internal ombudsman to the bank. And this is for what? Obviously, this is to improve the quality of customer services. This is actually for what? To improve the quality of customer services, right? Now, the person should not have worked in the bank in which she or he is appointed as CCSO. So this is very important. For example, that I am working in PNB currently, so I cannot be appointed as a CCSO for that bank today and even after tomorrow. So a person should not have worked in this bank or in that bank before appointing as a CCSO for that bank. Okay, so these are very important two things. So these two posts are, first of all, the principal nodal officer post, and second post, again a very important post, that is the chief customer service officer. And CCSO, this is also known as what? Internal ombudsman. This is also known as what? Internal ombudsman, right? Now, If we are going to discuss the RBI Integrated Ombudsman Scheme 2021, so this is the integrated scheme. Why it is known as integrated scheme? What are the concepts under this scheme? Now we have to discuss it completely. First of all, there was three schemes which was working. There were three schemes which were working. First of all, the ombudsman scheme for non-banking financial company. Second scheme was the ombuds. The first scheme was very common, the Banking Ombudsman Scheme 1995. The Banking Ombudsman Scheme 1995 was the very first scheme which was working. Second scheme was the Ombudsman Scheme for Non-Official Financial Companies, NBFCs. The Ombudsman Scheme for NBFCs, it was started in 2018. And the third scheme was Ombudsman Scheme for Digital Transaction, and that started in 2019. Okay, so these were the three schemes for different type of consumers. Like the NBFC scheme is for the larger NBFCs to handle the grievance of the customer which are related to the larger NBFCs. There was second schemes which was related to the digital transaction. There was the first scheme which was related to the banking ombudsman scheme. So these were the three different schemes which was working, right? Now these three schemes were integrated into one scheme which is known as the ombudsman scheme, the Reserve Bank of India Integrated Ombudsman Scheme 2021, and it was all to cover the regulated entities by RBI. It was actually to cover all the regulated entities by Reserve Bank of India. So it was the RBI Integrated Ombudsman Scheme 2021. Okay. Now, what is process of complaining under this scheme? If we talk about the screening scrutiny process, what are the process of complaining, right? So first of all, there is a CRPC. If we talk about in this RBI integrated ombudsman scheme, there is CRPC, Central Reserve Processing Center, which is in Chandigarh, and all the process, all complaints which are dealt or which are to be dealt by the ombudsman, this is first to be received in CRPC Chandigarh. Okay, this is the point of receiving the complaint, CRPC Chandigarh, right? Now, based on the preliminary scrutiny, means the first thing is CRPC has the right to reject and accept the complaint as the very first instance. After receiving the complaint, they analyze the complaint, and if the complaint is the valid one, they forward this complaint to the ombudsman. Okay, now what are these complaints which are valid? First of all, their scrutiny has been done by CRPC Chandigarh. The first is the complaints which are not valid. The first is the complaint which are not valid. So the complaint which is offering suggestions, seeking guidance or explanation. The complaints which are offering suggestion or they are seeking guidance or explanation, they are not valid. Okay, and they are closed at the very first step. They are not valid and they are closed at the very first step, right? Second, complaints which are not maintainable. Okay, so there are complaints which are not based on a permitted grounds, either they are separated and these are advised accordingly. Now there is a valid complaint, means which are actually in the form of complaint and maintainable, means which are under the scope of management of ombudsman. Now these complaints find to be valid and these are maintainable and these are assigned to the concerned ombudsman for the further examination, right? Now when the concerned regulated entity on receiving the complaint from CRPC, it's required to file with the concerned ombudsman along with the copy of document, and that should be filed within 15 days of receiving the complaint. That should be filed within 15 days of complaining, right? So this is the RBI Integrated Ombudsman Scheme 2021, the CRPC Chandigarh. Now, what are the awards that can be given under this scheme, who have actually started this. So what can be the award that can be given under this scheme? So the award, first of all, the direction to the regulated entity for a specific performance. For example, this there is some aggrieved person, he has gone to the ombudsman. Now this aggrieved person is of some bank, right? So this ombudsman can direct to the bank that you have to do something for this customer, like there is some special act or performance that you have to do. For example, if there is certain file which is not cleared, so you have to clear that file immediately. So these are the certain type of instruction that can be given by the ombudsman to the regulated entity for having some performance with that aggrieved customer, right? Now second thing is the amount compensation. Maybe the ombudsman can ask for the regulated entity that you have to compensate on this scenario. So the compensation can be the amount can be paid by the regulated entity to the complainant as the compensation for the loss suffered. Now, how this compensation, if we talk about this compensation, the compensation has different limit. First of all, it can be the actual amount which is involved in the dispute. It can be what? It can be the actual amount which is involved in that dispute without any ceiling. If there is some consequential loss, either by the direct act or the indirect act of the bank. Now, this can be the extent of actual loss with a ceiling of 20 lakh. For example, the loss is of 50 lakh. So the whole 50 lakh is compensated by the ombudsman, right? So it is comes with a ceiling of 20 lakh. Actual amount or the ceiling of compensation, actual amount or the ceiling of compensation, whichever is what, actual amount or the ceiling of compensation, whichever is lower, right? Third, compensation for the loss of time, expenses incurred, harassment, mental anguish suffered, up to the ceiling of rupees 1 lakh. Okay, so these were the awards that was given by ombudsman. Clear? Now next, if we talk about the rejection of the complaint, if we talk about the rejection of complaint, so yes, ombudsman has the right to reject the complaint if any of the complaint is any of these, under any of these circumstances. First of all, if there is no deficiency in the services. First, the complaint there is no deficiency in the services. Second, the compensation sought for the consequential loss which is beyond the power of ombudsman, because you know that the consequential loss, the ombudsman have the power to compensate with a ceiling of rupees 20 lakhs. So, ombudsman can reject the complaint if they think that okay, in this scenario the compensation should be the fullest, but they have the limit of 20 lakh in ceiling. Complaint is not pursued by the complainant with a reasonable diligence. There is no reasonable diligence while complaining about the regulated entity. The complaint is without any sufficient cause. Maybe there is a complaint which is without any sufficient cause, so these complaints should be rejected at once. The complaint requires a elaborate document or oral evidence. Or last, if in the opinion of ombudsman there is no financial loss or damage or inconvenience caused to the complainant. So these are the a situation in which the ombudsman can do what? The ombudsman can reject the complaint to the complainant. Clear? Now, let's start discussing some of the practice question. Everyone, just please like and share the video to the maximum you can. Everyone, whoever is joined this session, whoever has joined this session, it's a request, guys, that please like and share this video to the maximum you can. Okay, now let's start discussing the very first thing, that Dash act as an internal ombudsman of a bank. Everyone, please answer this question. Dash act as a internal ombudsman of a bank. This is chief compliance officer. This is chief customer service officer. This is chief risk officer or head internal audit. Dash act as a internal ombudsman of a bank. Everyone, please answer this question. Internal ombudsman of a bank. So if we talk about the internal ombudsman of the bank, who act as an internal ombudsman, it is CCS or Chief Customer Service Officer. They act as an internal ombudsman of the bank. Second, bank is required to have a principal nodal officer at the dash. Bank are required to have a principal nodal officer at dash branches, regional offices, zonal offices, or head offices. Bank are required to have the principal nodal officer at dash branches, regional offices, zonal offices, or head office. Everyone, please answer this question. Bank are required to have a principal nodal officer at what? At each of the branches. The correct answer is A, right? At each of the branches. Next, which of these modes of complaint to a bank will be not educate for filing a complaint with the ombudsman? Dropping in the complaint box through email to the specified ID, submitted at the branch with acknowledgement, or through website on the link specified. Which of the following these modes will not be educate for filing the complaint? Not educate for filing the complaint. Everyone, please answer this question. Which of the following these modes is not educate for filing the complaint? Dropping in the complaint box, email, submitting at the branch with acknowledgement, or through website on the link specified. Everyone, please answer this question. So the correct answer is what? So if we talk about the correct answer is yes, A. Dropping in the complaint box. The correct answer is dropping in the complaint box. Which of these modes of the bank will not be educate for filing a complaint with the ombudsman? It's the dropping in the complaint box. So A is the correct answer. Clear? Everyone? Yes or no? To discuss about PPB Module A, and the topic is the Consumer Protection Act 2019 Preamble, Extent and Definitions. Okay, so this we are going to discuss in today's session. So everyone, just please like and share the video to the maximum you can. Everyone, guys, whoever is watching this session, it's a request to just please like and share this video to the maximum you can. Okay, so let's start this Consumer Protection Act 2019. First of all, if we talk about the previous act, so the previous act was passed in year 1986. So the 1986 act, the objective was same. It is for the better protection of interest of consumer. It is actually for what? It is for the better protection of the interest of consumer. If we talk about the Consumer Protection Act 2019, it is extended to whole India, including the Union Territory of Jammu and Kashmir. Okay, so this act is applicable to the complete India. It is applicable to the Union Territory of Jammu and Kashmir also. If we talk about the exceptions of the Consumer Protection Act 2019, like which of the goods and services are those in which the Consumer Protection Act 2019 is not applicable? Okay, like the earlier 1986 Act, if there is any good for resale, if there is any good for commercial purpose, if there is any services that is rendered free of charge, if there is any service under a contract for personal service. So these are some of the Consumer Protection Act thing which are not applicable, right? Which are not the goods and services are if it is for resale, if it is for commercial purpose, if it is for free, then it is not covered under the scope and definition of CPA, Consumer Protection Act 2019. Okay, now if we talk about the new salient feature of CPA, so what are the new salient features of Consumer Protection Act 2019? First of all, if we talk about the definition, it actually defines the consumer, right? Specifically. So all the definitions in details have been covered under this Consumer Protection Act 2019. It adds a new feature of unfair contract, like it defines what is unfair contract, what is the value, etc. Now, product liability action also defines in the CPA Act 2019. It defines the design that includes the related aspect. It includes e-commerce and electronic service provider also. It includes advertising and endorsement also. It adds express warranty parameters also. It distinguishes manufacturer, product seller, product service provider. So all these are included under the Consumer Protection Act 2019. 2019. So these are all included under CPA, Consumer Protection Act 2019. Right now, if we talk about the Consumer Protection Act, previous and the current, right? What is the difference between the Consumer Protection Act 1986 and what is the difference between the Consumer Protection Act 2019? So if we are going to discuss about difference between CPA 2019 and CPA to 1986. First of all, if we talk about this, these have no separate regulator. Okay, Consumer Protection Act 1986, these have no separate regulators, whereas there is a central authority, Consumer Protection Authority, Central Consumer Protection Authority. This is also in short form, it is known as Central Authority, which is the special authority which has been formed for the regulating of this Consumer Protection Act 2019. Next, if we talk about the Consumer Protection Act 1986, the consumer could be filed in a consumer court. Complaint here was filed in the court where the seller's office was located. In the previous act, it was filed in the place where the seller's office was located. But if we talk about the new act, Consumer Protection Act 2019, now it is filed to a place where the complainant office reside, right? So it is filed in the place of what? It is filed in the place where the buyer resides. If we talk about product liability action, there's no provision for that, okay? Whereas here is the provision, right? Compensation is given for any of the harm or service caused, right? So here, if we talk about the Consumer Protection Act 1986, here the district is up to 20 lakh. Okay, so value, if we talk about the value, district is up to 20 lakhs, state is between 22 lakhs to 1 crore, and national is over and above 1 crore, right? But here, if we talk about the new act, district is up to 1 crore. District is up to 1 crore, right? So state is, it is between 1 crore to 10 crore, right? And national is over and above 10 crore. If we talk about the Consumer Protection Act, there is no provision for that. If it is, we talk about the Consumer Protection Act 2019, yes, there is a protection, and e-commerce is included here, right? If we talk about mediation cell, there was no mediation cell in the previous act, whereas the new, they have the mediation cell. Okay, out of court settlement, if they want to have an out of court settlement, there is a provision for that. So this is actually the difference between the older version of 1986 and the newer version of 2019. Clear? Next, now let's discuss who is the consumers. According to the Consumer Protection Act 2019, who is considered as the consumer? First of all, the consumer is the person who buys goods or hires service for consideration. So there is any person who actually take some goods or hire some services. Okay, they take some goods, they have some services for what? They have some services for the consideration. Consideration means you have given something is in written. For example, you have given some you can say money. Okay, you have given some objects. There should be a legal consideration in exchange of that. It exclude what? It exclude the product which is for resale and commercial purpose, that I have already told you. So under the Consumer Protection Act, you will not get the protection if you have purchased the product for reselling as well as for the commercial purpose, right? Now, third, if we talk about the third thing, the cover, it covers offline as well as the online transaction. It covers offline plus online transaction, electronic means, tele shopping, direct selling, or multi-level marketing, right? Okay, now if we talk about the Consumer Protection Act 2019, it applies to all goods and services. Okay, it excludes the good for resale, goods for commercial purpose, services rendered for free of charge, and there is the services under contract for personal uses. Okay, so these are the definitions which are actually excluded from the scope of definition. Good. Okay. Done. Okay, next. Now let us discuss about the consumer rights. So, what are the different consumer rights? If we talk about the consumer right, what are the different consumer? So, these are the different consumer rights. First of all, the consumer has the right to be protected against the false marketing of the good and towards any good which are hazardous to life and property. Okay, customer has the right to be informed, right to be informed about the quality, quantity, potency, purity, standards, prices of good products, services, etc. So the consumer has the right to be informed. Okay, the right to be assured. If we talk about the right to be assured, wherever possible, the consumer has the right to be assured. They can just select from the competitive price they are getting. Okay, if we talk about the next thing, the right to be heard, the consumer has the right to be heard. Okay, will receive the due consideration for appropriate fora. The consumer has the right to seek redress against the unfair trade practices or restrictive practices or any exploitation of the customer or consumer. The consumer has the right for the consumer awareness also. So there is a right to be protected, informed, assured, heard, readdressed, and the right to consumer affairs. Clear? Done. Next. If we talk about the various platforms, so there are various platforms under the Consumer Protection Act 2019. There are various platforms under the Consumer Protection Act 2019 to handle the consumer dispute. First, there is a Consumer Protection Council, Consumer Protection Central Consumer Protection Authority. There is a Consumer Dispute Readdressal Commission, and there is a Consumer Mediation Cell. So these are the four authorities. Okay, which actually handles the grievances of the customer. So if you have any disputes, these are held under these. Okay, now let us discuss about the important Consumer Protection Council. So there is a Central Consumer Protection Council, which is also known as Central Council. This is established by the central government. This is established by whom? Central government, and it has maximum 36 members. It has maximum 36 members. There is a State Consumer Protection Council, which is also known as the State Council. It is established by state. Maximum it has 10 members and it is meeting at least 2 times in a year. There is a District Consumer Protection Council, which is also known as the District Council. Okay, it is established by the state government for each district, chaired by the district collector. It comprises of the official and non-official members. Clear? Now, next, if we talk about the Central Consumer Protection Authority, if we talk about CPA, Central Consumer Protection Authority. So, Central Consumer Protection Authority 2019. It is also known as Central Authority. This is a regulatory body, like there is a THRI and FSI, which is a regulatory body for other sectors. So, for this consumer protection, there is a authority, regulatory authority, which is known as Central Authority, which was formed under CPA 2019. This is a very main difference which was not present in 1986 Act. So this was not present here. Okay, so if we talk about the central authority, so central authority consists of a chief commissioner and such members of other commissioner as prescribed. If we talk about the central authority, the headquarter of this central authority is in New Delhi. So functions. Now let us discuss about the functions. The functions of the Consumer Protection Act, the Central Consumer Protection Act. First of all, it can protect, promote, and enforce the rights of the consumer, right? It prevents the violation of the consumer right. It prevents the unfair trade practices. It ensures that there should be no false or misleading advertisement. It ensures that there should be no false or misleading advertisement. No person which actually publishes the false and misleading advertisement. Clear? Now, obviously, there is some ancillary functions also. So, what are the ancillary functions of the Central Protection Consumer Authority? So, the ancillary functions means what are ancillary? Ancillary means add-on functions. Okay, so there are different functions. There are add-on functions also. Now, what are the add-on functions? First of all, they have the power to inquire and investigate in the violation of any consumer, right? They can intervene in any proceedings, right? They can review the matter relating to the factors and inhibiting the enjoyment of consumer, right? They can recommend adoption of international convenience and best international practice, means whatever the international practice is going best with the banking system, they can adopt that, right? Next, undertake and promote researches in the field of consumer right. They can spread and promote awareness on consumer right. They can issue notices to alert the consumer against dangerous or hazardous or unsafe goods, right? Issue necessary guidelines to prevent unfair trade practices and protect the consumer interest. So these are some of the ancillary functions of the central authority, okay, CCPA. Now, let us discuss about the power of CCPA. Now, what are the power of this central authority? So, if we are going to discuss about power of central authority, first, it have the power to conduct inquiry. So, as a central authority, if they think that there is something fishy that is going on, they have the power to conduct that inquiry. They have the power to order or recall of the goods. Okay, so if they think that there is any good which is hazardous to life, if there is any goods which is hazardous to life, which is not good for the life, then they have the power to recall that. They have the power to discontinue the advertisement also. They have the power to search and seize the area also, right? Now, any person who fails to comply with the direction of this central authority, it can be published with a jail of to 6 months or a fine up to rupees 20 lakh, or a jail up to 6 months or a fine up to 20 lakhs or with. Now, if we talk about any manufacturer, or any service provider who causes a false or misleading advertisement, they can be punished with an imprisonment of 2 years and fines up to 10 lakh, okay, or the fine which can be extended up to 5 years, or there is a penalty of 50 lakhs. So, this is the Central Consumer Protection Authority. Clear? So this is the chapter. I have just given you the idea of whatever is important in this chapter. Okay. So we have discussed some of the important thing in this chapter. Now let us discuss about the practice questions. Let us discuss about some of the practice questions. The first thing is, State Consumer Protection Council has to meet at least dash in a year. State Consumer Protection Council has to meet at least a dash in a year. Everyone, please answer this question. The State Consumer Protection Council have to meet at least dash time in a year. Everyone, please answer this question. State Consumer Protection Council has to meet at least dash time in a year. So I have discussed it with you that State Consumer Protection Council has to meet at least 2 times in a year. 2 times is the correct answer, at least 2 times in a year. Clear? Next, if we talk about the next thing, person has brought a mixer grinder from a retailer, right? Its motor stop after 10 minutes of running. The liability for this defect will be of dash product manufacturer, trader, retailer, or product service provider. Everyone, please answer this question. Abroad, a person actually bought a mixer grinder from the retailer, right? So its motor stopped working after 10 minutes of running. The liability for this defects will be on product manufacturer, it will be on trader, it will be on retailer, or it will be on the product service provider. Everyone, please answer this question. Okay, so if we talk about the correct answer, yes, it is with product manufacturer. The correct answer is the product manufacturer. Clear? We are going to discuss about PPB Module A, that is Right to Information Act 2005. So this PPB Module A is almost finished right after this chapter. So let's start discussing this chapter. Everyone who is watching this video, first of all, it's a request that please like and share the video to the maximum you can. And if you haven't subscribed this channel yet, it's a request from my side that please subscribe this channel and press the bell notification icon, right? So let's start discussing this topic. First of all, the introduction. So let's read about what is the Right to Information Act. So this Right to Information, this is actually treated as a fundamental right. We have the right to be informed, right? So Right to Information Act, first of all, it has been passed in which year? This is very important. So this act has been passed in year 2005, right? And this was enacted with intent. This was enacted with the objective of setting out the practical regime for citizen to get information under the control of public authority in order to have a transparency, accountability, working of every public authority. Means right to be informed. So there is a provision that is given to every citizen that you have the right that you can ask a question. You are to be informed about all the workings under the public authority. Okay, so whatever the workings are there under the public authority, you have the information to be get informed under the Right to Information Act, right? So this is actually for what? This is actually for promoting transparency. This is actually for promoting accountability. This is actually for the working of every public authority, right? Now, Right to Information Act 2005, this actually provides citizen with the access to information held by the public authority. This is actually with the access to information that is held by the public authority. Now, this acts extend to whole of India. This is extended to whole of India, including the Union Territory of Jammu and Kashmir, all the private sector banks, other institutions which are owned and controlled by the government. These have the right that you are the public authority and you are accountable to the public. Means if the public is asking you any question, you have to inform the public about the workings of these institutions, right? Now, if we talk about these some definitions, these are the some definitions which are defined under the Right to Information Act 2005. Now, what are the definitions? First of all, there should be an appropriate government. Appropriate government means you have the central, you are the state-related public authorities. Any authority which are under the control of the state or central government, these are under the management of the central or state government. You are the appropriate government authority which comes under Right to Information Act 2005, right? Now, competent authority, there should be a designated individual which is empowered to receive the request. Okay, like there is a PIO, Public Information Officer, which is there for receiving the information to provide information about the working of the public authority, right? Next, information, you should provide the information in any accessible form, right? There should be a public authority body which has been established by constitution, law, or government financing, right? So there should be a record. There should be a record of what? There should be a record of various forms of material, right? Your right to information entitles citizen that you can access information held by the public authority, okay, if it is not confidential. Third party, there should be an individual or entities other than the citizens that is making the information request. The third parties are also allowed to use this Right to Information Act 2000. Okay. Now, next, if we talk about the obligation of the public authorities. Now, what are obligations of the public authority? What the public authorities need to be, what need to be do? Okay, because these are coming under the Right to Information Act. So first of all, maintaining record. It should maintain all its record. It should maintain all its record duly catalogued and indexed to facilitate fulfilling the right to information under this act. So you have to maintain all the records. So if you are maintaining the record, then only now you are providing any information if it is asked by the public authority. If you are not maintaining any record, how you can ask it from the public, right? So you have to maintain a record. You have to maintain all the record which are indexed to facilitate and fulfill the right to information under this act. Relevant facts for these policies. If we talk about the policies, whatever the policies you are following, you should present the relevant facts. You should publish the relevant facts related to that important policies. This is the obligation of the public authority. So it should do what? It should publish all the relevant facts while facilitating or formulating the important policies, right? A reason for decision. It should provide a reason for its administrative or quasi-judicial decisions to affected person. So if it should provide what reason, that for what purpose it is administrative and quasi-judicial decision to affected person, then you should provide information sometime on a suo motu basis. Suo motu basis, you yourself provide the information to the public. Every time the public need not ask you that what is going on, you just provide information by yourself on a suo motu basis. Okay, so they'll provide information as possible on a suo motu to the public at regular intervals about the various means of communication, including the internet. So these are some of the obligations under the authority, right? Everyone just please like and share the video. Whoever is watching this session, guys, it is a request that please just like and share the video to the maximum you can. Okay, because this is very important. This chapter is again very important to all of you. Just please take a time, like and share the video to the maximum you can. Okay. Okay, next. Let's talk about the different more obligations. Okay, so there was wide dissemination of the information. So all the information you are providing, okay, this should be widely disseminated. Okay, widely disseminated means it should be spread so that maximum public, maximum individual should know. For example, you are just providing the information in the notice board of your office. So who is coming to your office for accessing that information? So you have to provide it publicly, you have to spread it amongst the people, right? And whatever the information you are providing, there should be easy access for that, and it should be in a reasonable price. All the material, it shall be disseminated taking into consideration the cost effectiveness, local language, the most effective method of communication to the possible extent in an electronic format with the Central State Public Information Office available free or at a prescribed cost of the medium or the print. Okay, so this is what the easy access and reasonable. Okay, next, if we talk about the next thing, designation of the public information officer. So there should be a competent authority. I have already told you there should be a competent authority which were present to receive the request of right to information. So who is present to receive the information about or to receive the request about the right to information, right? So first of all, there should be a public information officer. Okay, now, every public authority is required to designate a central or a state public information officer in all the administrative unit or offices to provide information to the person requesting for the information under this. Okay, so public information officer, every public authority, they are required to designate some central or state public information officer. So PIO is the main person who is receiving every request and provide information to the public. Okay, now assistant public officer. So if we talk about the PIO, so there is a assistant public officer also to this PIO. Okay, now every public authority here is required to designate an officer at each sub-divisional level or other sub-district level also. Okay, as a central or a state assistant public information officer, so that they can receive applicants for information or appeal under this. Right now, third, assistance to other officers. Also, the state, central and state public information officer may seek assistance of any other officer, or he or she considered it necessary for the proper discharge of his or her duties. Right. So there is a public information officer, there is a public assistant to public information officer, and there is an assistant to other officer also. Right now, there are definitely some information which are exempted from disclosure. Okay, now these are some information which are exempted from disclosure. It, if anyone is asking information about these thing, okay, these are exempted from the disclosure. For example, first, if I'm talking about the India's sovereignty and integrity, so if it might harms India's sovereignty and integrity, it is exempted from disclosure. If it is forbidden by law, okay, if it could cause a breach of privilege of parliament or the state legislature, if it is related to commercial confidence, trade secrets, or intellectual property, if it was a personal information which cause any unwarranted privacy concern, if it would impede the process of investigation or apprehension or prosecution of offender, if it is a cabinet paper, if it disclosure would endanger the life, if the information received in confidence from any foreign government. Right, so if these are the area, okay, if these are the area, this is actually exempted from disclosure. So if the IO is receiving a request to disclose any of these information, these are actually rejected for disclosure. Okay, now if you have any doubt till now, please ask your doubt. Everyone, guys, who is watching this session, just please tell me if you have any doubt. Please ask your doubt. Any doubt, guys? Please just tell me if you have any doubt. Please ask your doubt. If you have any doubt, you are free to ask your doubt. No doubt? Clear? Everything is clear? No doubt? Okay. Now, last, appeals. Now, where you can appeal. Okay, so appeal can be made within 30 days to the senior officer over and above the central PIO. So, if you are dissatisfied with the central public information officer, if you are dissatisfied with the central public information officer, you can file an appeal over and above the central public information officer, and that should be within 30 days to of the final order. Okay, now 30 third party information, third party appeals must be made within 30 days again of the order. Now, if you are not even satisfied with the seniors who are over and above the central PIO, so second appeal can be given against that to the central or state information commission, and that should be within 90 days against appellate authority decision. So there is an appellate authority, there is central PIU, you are going here. You are not satisfied, go to the appellate authority. You are not satisfied, go to the central or the state information commission. Okay, now whatever the decision central and state information commission is taking, it is final and binding on all parties. So this was the appeal you have to make. Clear? Done? Okay, so this was the complete chapter. I hope that you have all understood this chapter. Okay.